Please like, share, and subscribe. Wishing you happiness and good luck every day.
Okay, let's be honest. When you hear the name Berkshire Hathaway, you really just think of one person, right? Warren Buffett, the Oracle of Omaha. But what if I told you the real secret to Berkshire's mind-boggling success isn't just the genius of one man? What if it's this incredible, totally unique corporate machine that he built, almost completely by accident? Well, we're going to pull back the curtain and see exactly how this accidental empire truly works.
In this quote, this is the perfect place to start. You have to understand, this isn't just some nice-sounding platitude. This is the bedrock. It's the one non-negotiable rule at the heart of the entire company. It tells you, right from the jump, that this is about so much more than just dollars and cents. It's about an ironclad commitment to integrity, a code that governs an empire that touches our lives in way more ways than most of us ever realize.
I mean, think about it. You've probably driven by a Dairy Queen. Maybe you've insured your car with GEICO, or seen one of those massive BNSF trains rumbling past. We bump into the Berkshire Empire pretty much every single day. But here's the thing. Almost nobody understands the truly bizarre and frankly brilliant structure that holds this whole thing together. So what is it?
Right. If it isn't just Buffett's legendary ability to pick stocks, what's the actual engine driving this thing? Well, the answer is this powerful combination of three very distinct and, really unusual systems that all work together in this perfect, self-reinforcing loop. So let's break them down one by one.
First up, we have to talk about the money. I mean, you have to. This is the financial engine room, the place that provides the high-octane fuel for everything else Berkshire does. And this is where the magic really starts, with a concept that sounds kind of dry, but believe me, it is one of the most powerful financial tools ever created. It's called insurance float.
So what the heck is float? Well, think about it like this. When you pay your car insurance premium to a company like GEICO, you're paying them up front for coverage for the next 6 months or a year. GEICO gets to hold on to your cash right now, but they might not actually have to pay out any claims on your behalf for months or even years, if ever. That giant pile of cash that they get to hold and invest for their own profit before they ever have to pay claims, that, my friends, is float.
And what's really fascinating is how Buffett first got his head around this idea. It wasn't even with insurance. It was with trading stamps, like S&X green stamps. Your grocery store would buy millions of these stamps for cold, hard cash, so the stamp company gets all that money right away. Meanwhile, you, the shopper, are slowly collecting stamps in a little book, and only much, much later do you maybe redeem them for, a toaster. All that time in between, the stamp company has a massive interest-free loan to go out and invest. That's float. And Berkshire just applied that simple idea on a colossal scale. And when I say colossal, the scale is it's breathtaking. We are talking about a pool of capital, a float, of over $70 billion. Now, this isn't a bank loan where you have to pay interest. Nope. This is, for all intents and purposes, zero-cost capital. It's the permanent war chest that lets Berkshire swoop in during a financial crisis and buy whole companies without borrowing a penny. It's the absolute powerhouse that fuels the entire enterprise.
So you've got this incredible financial engine, but how on earth do you manage the dozens upon dozens of totally different companies you own with all that cash? Well, that brings us to the second key piece, an operating system that is so counterintuitive it breaks pretty much every rule of modern business management.
Just look at this. It's almost comical. On one side, you've got your typical corporate headquarters, floors and floors of MBAs, entire departments for strategic planning and synergy. And then you have Berkshire Hathaway's world headquarters, a staff of about 25 people. Let that sink in for a second. A multi-hundred-billion-dollar company is run by a team that could fit in a large conference room. They don't have strategy meetings. They basically just allocate the money and then let their CEOs run the show, completely.
And this quote from Buffett's longtime partner, Charlie Munger, just says it all. He wasn't exaggerating, not one bit. Their philosophy is simple. Buy a great business that's run by a great manager and then get the hell out of the way. The amount of trust they put in their people is, it's basically unheard of in corporate America. And if you want to know just how extreme we're talking, you have to hear this story. It's almost unbelievable. The CEO of one of their companies, a man named Lou Vincenti, actually ran his company for several years while suffering from Alzheimer's disease, and neither Buffett nor Munger even knew. Munger later said, "He liked coming in, and he wasn't doing us any harm." It's a shocking, almost jarring story, but it's a testament to just how deeply this hands-off philosophy runs.
So why does this matter? Because this isn't just some quirky management style. It's a massive competitive advantage. The best entrepreneurs, the best managers out there, they are drawn to Berkshire because they know they won't be micromanaged. They get to keep running the business they built the way they built it, and that's exactly why Berkshire wanted them in the first place. This autonomy attracts the kind of A-plus talent that makes the whole system work.
Okay, let's move on to the third and final piece of this puzzle. We've talked about the money, we've talked about the management, but what's the glue that holds it all together? Well, it's the cultural DNA, a set of really deeply ingrained values that defines what it actually means to be a Berkshire Hathaway company.
The first pillar of this culture is this intense, almost religious focus on keeping costs down. And we're not just talking about being frugal. We're talking about making low costs a strategic weapon. And there is no better example of this than the legendary founder of Nebraska Furniture Mart. Rose Blumpkin, everybody just called her Mrs. B, built a furniture empire on one simple idea: sell cheap and tell the truth. Her prices were so insanely low that her competitors actually sued her, claiming it had to be illegal. So she goes to court, proves she's still making a profit, wins the case, and then, and this is the best part, the legend goes, she sold the judge $1,400 worth of carpet right there in the courthouse. That, right there, is the Berkshire DNA in action. All right, the second cultural pillar. This one brings us full circle, right back to that quote we started with, reputation. See, at Berkshire, a good reputation isn't some fuzzy PR concept. No way. It is a tangible asset that produces real, hard financial results, especially when times get tough. A perfect example of this is Clayton Homes during the 2008 financial crisis. Now, they were in the manufactured housing business, which was basically ground zero for the whole subprime mortgage disaster. But while their competitors were writing all these reckless loans that were just bound to blow up, Clayton stuck to responsible lending. So when the entire industry came crashing down, Clayton's reputation for integrity meant they didn't just survive, they thrived. Their good name was their shield. And all of this leads to this really powerful idea: Berkshire as a permanent home. Look, if you've spent your entire life building a family business, the last thing you want is for some private equity firm to swoop in, load your company up with debt, and then flip it in 5 years. Business owners come to Berkshire because they know Buffett is the final stop. He's going to preserve their company's legacy and its culture. He's offering a stable, permanent home for their life's work. So, when we put all these pieces together, this endless supply of money, the totally radical management style, and this very unique culture, we can finally see the complete picture. We can see what Warren Buffett famously calls the moat that protects the Berkshire Castle. And this is how it all locks together. It's a self-reinforcing flywheel. See, the zero-cost float from the financial engine provides all the capital. The hands-off management philosophy attracts the absolute best owner-operators to put that capital to work. And the cultural DNA, the reputation, the permanence, it ensures they do it with a long-term mindset, which in turn strengthens the brands, which generates even more float. And that makes Berkshire an even more attractive home for the next great business. You see, each piece makes the other two stronger. So, at the end of the day, the crucial point is this. While Warren Buffett is without a doubt the legendary architect, the true enduring genius of Berkshire Hathaway is the self-perpetuating, powerful, and utterly unique machine that he built. It's an ecosystem that attracts and compounds capital, talent, and culture in a way that really no other company has ever managed to do. Which of course leaves us with one final fascinating question. This whole empire was in many ways an accident of history, a unique product of a specific person at a specific time. So can its core principles, this absolute trust in people, this obsession with reputation, this relentless long-term focus, can any of that be bottled up and deliberately replicated? Or was Berkshire Hathaway just a lightning strike that we are never going to see again? You know, some stories, they just don't seem like they should be true. This is one of them. It's the story of how one of the most successful companies on the planet was born, not from some grand, brilliant vision, but, well, from an act of petty revenge. It was forged to a series of painful mistakes and a set of principles hammered out in the fire of public crises. This is the incredibly unlikely origin story of Berkshire Hathaway.
And that right there, that's the central question, isn't it? We all know Berkshire Hathaway today as this absolute fortress of investing, but its origin, it's a failing business that its founder, Warren Buffett, later said he would have been far better off had he never heard of. So how on earth did that become this? To really get it, we've got to trace the key moments that shaped its DNA. We're going to start with its accidental beginning and the painful mistake that almost stopped everything before it started. Then we'll get into how a guy named Charlie Munger sparked a total revolution, why they actually started paying too much on purpose, and how a few major crises forged their entire culture. And finally, we'll decode the principles that make Berkshire Hathaway what it is today.
Okay, so let's rewind the clock. Our story kicks off in 1956. A 26-year-old Warren Buffett starts his own little investment partnership in his hometown of Omaha. And he's got this very clear, very simple philosophy that he picked up from his mentor, the legendary Benjamin Graham. This whole philosophy was about one thing: bargain hunting. They called it the cigar butt approach. It's a funny image, right? The idea is you walk down the street, you find a discarded cigar with one good puff left in it. You get that last puff for free and you toss it. In investing, that meant finding a company that was trading for less than its assets were worth if you just sold everything off. It was a pure numbers game. And that game is exactly what led him to a struggling textile mill in New England called Berkshire Hathaway. And this is where the story takes a hard left turn. See, Buffett's initial play with Berkshire wasn't some grand long-term vision. Nope, it was just another cigar butt trade that went completely sideways because of a tiny, tiny amount of money and a very large amount of ego. And if you looked at the math, it seemed like a slam dunk. The company's book value, what its assets were worth on paper, was over $19 a share. But Buffett, he was scooping up huge chunks of it for less than $8 a share. From a pure bargain hunting perspective, this was an absolute no-brainer. The plan was simple: just wait for the company to buy back its own stock, sell his shares back to them, and walk away with a nice, easy profit.
So Buffett has a chat with the CEO, a guy named Seabury Stanton, and they make a verbal agreement. I'll sell you my shares for $11.50. Easy enough, right? Well, when the formal written offer shows up, it's for $11.38. We're talking a 12.5-cent difference. Buffett was absolutely furious. He felt like Stanton was trying to nickel and dime him, to chisel him over pocket change. So in what was basically a fit of rage, instead of selling, he did the exact opposite. He started buying up shares like a madman, took control of the entire company, and the first thing he did, he fired Stanton.
And just like that, he was the proud new owner of a dying textile mill. A terrible business in a terrible industry, fighting a losing battle against cheap foreign labor. He ended up pouring money into it for 2 decades, trying to keep it alive, before finally, mercifully, closing the mills for good in 1985. This quote, it just says it all. He won the battle with Stanton, but he was now stuck with this horrible business. It was a victory born of pure anger, and it was a massive, painful mistake. But, and this is the whole point of the story, that colossal mistake became the absolute bedrock of the entire Berkshire philosophy. The agony of having to fire people and shut down those mills, it forged a brand new set of rules. Rule 1, no more hostile takeovers. Rule 2, a commitment to permanence. When we buy a company, we're in it for keeps. And maybe most important of all, a huge shift away from buying terrible businesses at cheap prices and towards buying wonderful businesses at fair prices. Now that last lesson, that final crucial piece of the puzzle, that wasn't something Buffett just came up with on his own. It was drilled into him over and over by his business partner, Charlie Munger. And this was the moment that Berkshire's entire investment brain got a fundamental rewiring.
And the shift in thinking was just profound. You had Buffett, who was a student of Graham, totally focused on the numbers. He'd buy a merely fair business if the price was good enough. Munger comes in and says, no, that's completely backwards. We should be buying a truly good business even if we have to pay a fair price for it. He was the one who pushed Buffett to look beyond the balance sheet, to think about the stuff you can't put in a spreadsheet, the strength of a brand, the integrity of the people running the show, a company's reputation. The first big test of this brand new philosophy came in 1971 with See's Candies. Now, this wasn't just some random company. This was a beloved, multi-generational family business built on quality and tradition. It had been started back in 1921 with Mary C's original recipes, and over the decades, it had grown into this West Coast institution with this incredibly powerful, if unquantifiable, brand loyalty. Now, the old Warren Buffett, the cigar butt Buffett, he would have run away from this deal screaming. The family was asking for $30 million for a company that had only $7 million in net assets. I mean, the price was more than 3 times its book value. But Munger just kept pushing, arguing that the brand, that customer loyalty, was this enormous hidden asset that didn't show up on the balance sheet. They ended up paying $25 million, a huge premium, and it was the very first time they paid for quality over just a cheap price. Turns out, it became one of their most successful investments ever. Okay, so they learned to pay a fair price for a great business. But what about
I don't know, intentionally paying more than you have to? The next story, involving a company called Wesco Financial, seems to defy all business logic, but it reveals an even deeper principle about what value really means.
All right, you got to stick with me here because this sequence of events is just wild. So Buffett and Munger are shareholders in Wesco, and they think a planned merger is a raw deal for investors, so they block it. As you'd expect, when the deal falls apart, Wesco's stock tanks, dropping from $18 all the way down to $11. Now, this is their moment to swoop in and buy the company for cheap, right? Wrong. In a move that made no sense to anyone, they told their brokers to buy shares for as much as $17, way above the market price that they themselves had just caused. The whole thing was so bizarre, the SEC actually had to launch an investigation.
So why? Why on earth would they do that? It was an investment in reputation. That's it. They felt it would be fundamentally unfair to profit from the low stock price that their own actions had created. By intentionally overpaying, they were sending this crystal-clear message to the entire business world. We are fair partners. We will not take advantage of you. They understood that integrity wasn't just some nice moral virtue. It was a real, tangible economic asset that would attract better business deals for decades to come.
You know, it's one thing to have these principles you talk about behind closed doors, but the real test of a company's culture, that's what happens when you're under the intense pressure of a public crisis. And for Berkshire, two huge events would take their quiet philosophy and basically etch it in stone for the whole world to see. First, there was the battle for Buffalo. When Berkshire bought the Buffalo Evening News, they immediately launched a Sunday edition to compete head-to-head with their rival. Well, the rival sued, and the judge was not impressed with Buffett's style. He couldn't believe that Buffett had done zero traditional due diligence before buying the paper. He got absolutely skewered in court, painted as this outside invader, a predatory monopolist. But Buffett didn't back down. He held firm, he eventually won on appeal, and he proved that his conviction-based, non-traditional way of doing things could stand up to a full-on public and legal assault.
But that crisis was nothing compared to the next one. In 1987, Berkshire made this massive investment in the Wall Street firm Salomon Brothers. Fast forward just 4 years, and Salomon is completely engulfed in a gigantic scandal involving illegal bond market trading. The whole firm was on the verge of being indicted and collapsing, which would have completely vaporized Berkshire's investment.
To save the firm, the board basically begged Buffett to step in as the interim chairman. His job was to clean house and somehow restore trust. And this quote, this is the simple, powerful directive he gave to every single employee. It's the ultimate test of ethical behavior. Don't just stay within the lines of the law. Operate in a way that you'd be proud to see scrutinized on the front page of the newspaper. This became the ultimate public declaration of what Berkshire was all about.
So when you take all these different stories, the mistakes, the huge shifts in thinking, the public battles, and you put them all together, you can start to see this clear, coherent code emerging. It's like a corporate DNA that was written, one experience at a time, over decades.
And you can literally draw a straight line from every core belief at Berkshire Hathaway today back to one of these formative events. That deep commitment to permanence, that comes directly from the pain of closing those textile mills. The focus on quality over price, that was the Munger revolution sparked by See's Candies. The idea that integrity is an asset was a lesson they literally paid for in the Wesco deal. That unconventional conviction was proven in the battle for Buffalo, and the ultimate rule that reputation is paramount was forged for all to see in the Salomon crisis.
It all comes back to that famous Buffett saying, price is what you pay, value is what you get. And these early deals show it perfectly. With See's Candies, you could argue they underpaid on price because the value of the brand they got was immense. And with Wesco, they deliberately overpaid on price because the value they were really buying, a reputation for absolute integrity, was priceless.
And that really brings us to the final question, doesn't it? When you look at the story of Berkshire Hathaway, it seems like this entire empire was built on things you can't really quantify: reputation, trust, permanence, integrity. It really makes you wonder if, in business, and maybe in life too, the most valuable assets we have are the ones that never ever show up on a balance sheet. Something to think about. Thanks for joining me.
All right, let's talk about a company that, on the surface, looks less like a corporation and more like someone went on the most random shopping spree in history. We are talking about Berkshire Hathaway, an absolute empire of everything.
So, let's really get into this, because you have to wonder, how in the world does owning a massive freight railroad, a giant car insurance company, and a beloved candy maker all under the same roof make any sense at all? What's the hidden logic here? What's the thread that ties all of this together and makes it one of the most successful companies on the planet? Well, let's figure it out. To get to the bottom of it, we actually have to go back in time. We're going to travel to one single pivotal year that pretty much lays out the entire playbook. The year is 1986, and two totally separate stories are playing out at the same time. On one hand, a letter shows up on Warren Buffett's desk from a company he's never even heard of. And on the other, he's just reading the newspaper, following this big, dramatic, hostile takeover battle. And somehow, these two completely unrelated events are about to lead Berkshire to buy two companies that could not be more different from each other.
I mean, the contrast here is just night and day. In one corner, you've got Scott Fetzer, a big publicly traded company with like 31 different divisions, making everything from World Book encyclopedias to Ginzu knives. They were in a desperate fight for their life, trying to get away from the infamous corporate raider Ivan Boesky. And in the other corner, F.H.I.R.E brothers, a tiny, private, family business that had been making uniforms since 1842. They weren't running from anybody, they were actively looking for a permanent, safe home.
So, why on earth would Berkshire buy both? One was this public giant, the other was this tiny private company. Well, the answer reveals the secret DNA, the blueprint for basically every single Berkshire acquisition that came after.
You see, it turns out Buffett wasn't really looking at what they made. He wasn't worried about their corporate structure. He was looking for something deeper. He was looking for three specific things that both of these very different companies shared. 1, they were consistently profitable. 2, they were leaders in what they did. And 3, this is the big one, they were run by really good, really committed managers. It didn't matter if they were professional execs or the great-great-grandson of the founder.
But here's what makes it all click. This wasn't just about what Berkshire wanted. The deals worked because Berkshire offered the two exact things that both of these companies desperately needed. First, the promise of autonomy, the freedom to keep running their business the way they knew how. And second, permanence, a guarantee that they wouldn't just be bought and then flipped or sold for parts a few years later.
And right there, that's the solution to the whole puzzle. The unifying idea behind Berkshire Hathaway has nothing to do with industry synergy or clever corporate strategy. It's a philosophy. It's about providing a permanent, hands-off home for great businesses that are run by great people. That's it. That is the secret sauce.
So, once you understand that one core principle, the incredible, almost bizarre diversity of Berkshire's portfolio, well, it suddenly starts to make perfect sense. It's not a random mess, it's a universe of companies all brought together for the exact same reasons.
And today, that universe is so big, they have to organize it into 4 main quadrants. You've got the insurance operations, like GEICO, which was really the original foundation. Then you have the huge, regulated, capital-intensive businesses. Think the BNSF Railroad. There's a finance group with companies like Clayton Homes. And then you've got this 4th bucket, which is just this massive cluster of everything else. We're talking See's Candies, Dairy Queen, you name it.
But the diversity isn't just about what they sell. When you start digging into the financials, the variety is just as staggering. This is not a company that just follows one simple formula. Just take the price tag. Back in 1986, Berkshire bought about 84% of F.H.I.R.E brothers, that uniform company, for just $46 million. Okay, a decent chunk of change, right? But just watch this.
A couple of decades later, they go out and buy the BNSF Railroad for $44 billion. That is nearly 1,000 times more money. I mean, the sheer scale of ambition here is it's mind-boggling. And it's not just those two extremes. As you can see, Berkshire plays across the entire field. You've got the multi-billion-dollar behemoths like BNSF. Then you've got deals in the single-digit billions, deals in the hundreds of millions, all the way down to beloved brands like See's Candies, which they bought for less than $100 million. The key takeaway is this: there was no right size for a Berkshire deal.
Okay, so what about the price they're willing to pay, the valuation? You'd think a famous value investor like Buffett would only buy cheap companies, right? Sticking to a low price-to-earnings ratio, which is basically how much you pay for each dollar of profit. But that's not what the data shows at all. He paid less than 8 times earnings for Fruit of the Loom, but then paid a much higher 14 to 17 times for Benjamin Moore Paints. And for Mid-American Energy, over 30 times earnings. So it's not about finding cheap stuff. It's about paying a fair price for the right kind of business.
But what happens when this model doesn't work? Because, it's not foolproof. And honestly, looking at one of their failures tells us more about how Berkshire really works than any of the successes.
So back in 1993, Berkshire bought a company called Dexter Shoe,
On paper, it looked great. Strong brand, long history. But Buffett admits he missed a huge, fatal flaw. Its American factories just couldn't compete with cheap labor from overseas. He later called it, in his own words, the worst deal I ever made.
Now this is where the story gets really incredible. Any normal company would have just shut Dexter down, sold off the assets for pennies on the dollar. But Berkshire did something totally unique. They realized that even though the factories were worthless, the brand name, the Dexter name itself, still meant something to people. So they did something like a corporate organ transplant. They moved the brand over to another shoe company they already owned, H.H. Brown.
And this move reveals a hidden superpower of the Berkshire model. You see, H.H. Brown was already a successful, resilient business. They were smart. They made their fancy, high-end shoes in the U.S., but made their more standard shoes overseas. They were strong enough to absorb Dexter's failure and keep the brand name alive. It shows how this family of companies can support each other in ways a typical corporation just can't.
So after all this, looking at railroads and candy and shoes that worked and shoes that didn't, what is the real common thread here? What's the intangible glue that holds this whole incredible empire together?
I'll tell you this much. If you're looking for the answer on a spreadsheet, you will never, ever find it. It's not about the P/E ratios, it's not about the deal size, it's not about some clever synergy that nobody else sees. All of that stuff is secondary.
The real unity of Berkshire Hathaway isn't found in what its companies do. It's found in what Berkshire is. It's a belief system, a philosophy that has stayed the same for more than half a century. And you know, in a business world that is absolutely obsessed with constant disruption and hitting quarterly numbers, Berkshire's dead simple human idea to find the best people and then trust them and leave them alone might just be the most radical and powerful strategy of them all.
All right, welcome. You know, we all hear about legendary companies, but how do they actually get that way? Today, we're going to pull back the curtain on Berkshire Hathaway. And no, we're not just talking about their stock picks. We're digging into something much deeper, their culture. That's the real secret sauce, the magic formula behind one of the most successful companies, well, ever.
So to kick things off, let's start with a quote that Warren Buffett himself loves to use. From Winston Churchill, "You shape your houses, and then they shape you." It's such a powerful way to think about it, right? For Buffett, corporate culture isn't some fluffy mission statement you hang on the wall. No way. It's the actual house you're building, brick by brick. And once that house is built, well, it starts to shape everything and everyone inside it.
Okay, so before we go any further, let's just make sure we're all on the same page. What is corporate culture, really? The best way to think about it is like the invisible architecture of a company. You can't always see it, but it's there. It's that set of shared beliefs, the unwritten rules that tell everyone, from the top dog down to the newest hire, how things are really done around here.
All right, here's our game plan for today. We're going to start with their unchanging principles. Then we'll see how that creates a real partnership of owners. We'll get into their famous hands-off approach, decode the key Berkshire traits, and then, finally, we'll see how it all pays off in culture equals performance. Let's get into it. First up, the unchanging principles. You know, you can't build a skyscraper without a solid blueprint, right? Well, for Berkshire, that blueprint is this set of principles, and they are absolutely non-negotiable. We're talking about ideas that have been set in stone for decades. This is the bedrock of the entire company.
And this is where it gets really incredible. Take a look at this. Their main rules for buying companies. They were first published way back in 1986, and today, they are exactly the same. They literally print the same list in every single annual report. The only, and I mean only, thing they've tweaked is how big the companies need to be. Just think about that for a second. In a world that's constantly changing, that level of consistency is just unheard of. It creates this incredible foundation of stability.
So what are these magic rules? Well, here they are. And what's amazing is how straightforward they are. They want companies that are already making money, that have good returns on equity, without a bunch of debt, by the way. And this is a big one. They want the management to stay right where they are. They also stick to businesses they can actually understand. Nothing too complicated. And finally, they refuse to overpay. See, this isn't just a checklist for their finance guys. It's a cultural filter. It's designed to make sure that any company joining the family already kind of thinks like them. But wait, there's more. The blueprint isn't just about buying companies. There's a whole other set of principles that are all about the owners, the shareholders. And just look at the words they use. Partnership. Hold subsidiaries forever. This tells you everything you need to know. This isn't about flipping companies for a quick buck. It's about building something that lasts. And it's about treating shareholders like they're true partners in the venture.
Okay, next section, a partnership of owners. And this is where it all comes together. Because here's the thing. All those principles we just talked about, they're not just lines in an annual report. They have a massive human impact. They act like this giant magnet, pulling in a very specific type of person, a specific type of owner. And this one idea right here, it's a total game changer. Just stop and think about it for a second. Most companies, what do they see when they look at their shareholders? They see a source of cash, people who might hold the stock for a few months, maybe a year. But Berkshire, they see partners, partners in an endless venture. It's a completely different mindset, and that one little shift changes absolutely everything.
And hey, don't just take my word for it. The numbers back it up loud and clear. Take a look at this chart. The annual turnover rate for Berkshire shares, meaning how often the shares change hands, is just a fifth of what you see at other big companies. A fifth! That means people who buy Berkshire, they hold on. They're not day traders, they're partners. This isn't just a feel-good philosophy. It has a real, tangible effect. So what you end up with is this totally unique ecosystem. I mean, where else do you get over 35,000 people making a pilgrimage to an annual meeting? It's like a rock festival for capitalists. And when you look at who owns the stock, it's not a bunch of Wall Street institutions that'll sell at the drop of a hat. It's mostly individuals and families. It goes all the way to the top. The board of directors is filled with friends and family who put their own skin in the game, buying tons of stock, and get this, they don't even have liability insurance. They are true owners, through and through.
So, this culture of ownership then allows for something else that's pretty radical, their hands-off approach. It's a whole management structure that, honestly, you just don't see anywhere else. And it's all built on one thing, a massive amount of trust.
I mean, just look at the difference here. On one side, you've got your typical big corporation, a massive headquarters building buzzing with layers and layers of managers, strategists, VPs of synergy, you know the drill. And then you have Berkshire. Their entire corporate headquarters is this tiny little office. Seriously, it's staffed with just enough people to handle the financial reporting. That's it. And the reason they can do that is simple. They buy great companies, run by great people, and then they just leave them alone. They trust them to do their jobs. It's the ultimate hands-off approach.
All right, moving on. We're going to decode the Berkshire traits. So we've talked about the blueprint, the principles, and we've talked about the architecture, that structure of trust. But what about the people and the businesses living inside this house that Buffett built? What's the cultural DNA that ties them all together?
Yeah, if you had to boil this whole massive, complex culture down to just a handful of core values, what would they be? It seems like a tough question, right? But the answer is actually incredibly elegant, and it's been hiding in plain sight this whole time, right in the company's name.
And here it is, the Berkshire acrostic. It's kind of brilliant, isn't it? These are the 9 traits that really make up the company's DNA. Let's run through them. B for budget conscious, these guys are famously frugal. E for earnest, they do what they say they're going to do. R for reputation, it's everything. K for kinship, they love family-owned businesses. S for self-starters, they want entrepreneurs. H for hands-off, we just talked about that. I for investor savvy, you got to know value. R for rudimentary, keep it simple. And finally, E for eternal. When they buy a business, it's a permanent home. That right there, that's the Berkshire Code.
So, culture equals performance. I know what some of you might be thinking. Okay, this all sounds very nice, but does any of this soft culture stuff actually make a difference? Does it show up in the numbers? The answer is a resounding yes. Let's talk about the payoff.
You see, having a culture like this isn't just about feeling good. It is a stone-cold competitive advantage. Think about it. When you're known for being careful and reliable, banks give you better credit ratings, which means you pay less to borrow money. When you have a reputation for being honest, suppliers and customers want to work with you. They'll even give you better deals. Every single one of these things adds up, and over the long haul, it creates truly outsized financial returns.
So let's bring it all home. If we go back to that Churchill quote, you shape your houses and then they shape you, the biggest lesson from Berkshire Hathaway is that culture is never, ever an accident. It is a choice. It's a deliberate act of building something. The principles you choose, the people you bring in, the level of trust you're willing to give, those are your bricks and mortar. So as we wrap up, it really leaves you with one big question to think about. What kind of house are you building?
At the very heart of Warren Buffett's empire, Berkshire Hathaway, lies a massive insurance business. And it's built on a paradox, really. On one hand, you have this obsession with saving every last penny. And on the other, you have these promises that are so unbreakable, they're worth a fortune. So today, let's pull back the curtain and unpack Berkshire's real secret sauce. I mean, think about it for a second. How can one single company be the absolute low-cost leader for your daily commute through GEICO and also be the go-to insurer for the most bizarre, out-there risks you can imagine? We're talking about things like a billion-dollar prize for a perfect basketball bracket. It sounds crazy, right? Like a total contradiction. But it's actually the key to understanding the genius of Berkshire. It really breaks down into two big ideas. On one side, you've got budget consciousness. This is the art of thrift, right? It's all about saving customers money to drive a huge amount of business. And then on the other side, you have earnestness. This is the power of trust, of keeping unbreakable promises when the stakes are incredibly high. They look like they're from different planets, but believe it or not, they're built on the exact same incredibly powerful foundation. So here's how we're going to tackle this. First, we'll dive into GEICO's model of thrift. Then, we're going to explore that world of earnestness with National Indemnity and Gen.Re. And finally, we'll put it all together and see how these two values create Berkshire's legendary economic moat. All right, first up, GEICO. This is a story all about how being obsessed with being the low-cost provider isn't just about making more money. It's about building a fortress, an indestructible advantage that your competitors just can't touch. You know, the history of GEICO really plays out like a 5-act drama. It all starts with this brilliant idea back in '36. Then this young kid named Warren Buffett stumbles upon it in '51. But then things go south in the '70s and it nearly collapses, only to be rescued by Berkshire in '76. And finally, it becomes this absolute crown jewel for the whole empire in 1995. Yeah, this journey, it really shows you just how powerful and honestly how fragile that business model was. Leo Goodwin's original recipe for success was, it was simple, but just so potent. First, target the safest drivers out there, government and military folks. Second, cut out the middleman, no expensive agents. Third, and this is the really crucial part, pass those savings on to the customer. And finally, you back it all up with incredible service. In 1941, after a hailstorm, he had local shops working around the clock just for his people. That's how you build some serious, ferocious loyalty. And this right here, this is the light bulb moment for that 20-year-old Buffett during his 4-hour meeting. He saw that GEICO didn't just have a cheaper product, it had a structural advantage. Its competitors, they were completely trapped in their high-cost agent model. They literally couldn't copy GEICO without basically setting their own businesses on fire. Now that, my friends, is what you call a deep, durable, competitive moat. And look at this. You can see just how huge that moat really was. By '86, GEICO's costs were only 23.5% of the money it brought in. The rest of the industry, they were spending almost 15 percentage points more. That is a massive gap. And it meant GEICO could either just pocket tons of profit or, and this is the genius part, give it back to customers with prices nobody could beat. But even the best moats can dry up. And in the 1970s, after the founders were out of the picture, GEICO's new bosses made a classic mistake. They got greedy. They just chased growth for growth's sake. They threw their underwriting discipline out the window, started insuring pretty much anyone, and completely missed the boat on new no-fault insurance laws. They were pricing risk without having a clue what it would actually cost. And the result? Well, they were on the brink of bankruptcy. I mean, by the time Berkshire Hathaway had to step in with a boatload of cash to save them in '76, GEICO was just a shadow of its former self, commanding less than 2% of the market. It was just a brutal lesson. A cost advantage means nothing if you don't have the discipline to protect it. Okay, so let's flip to the other side of Berkshire's insurance coin. We're leaving the world of GEICO, high volume, low cost, and stepping into the high stakes, high margin universe of National Indemnity and Gen.Re. This is a world where the only thing you're really selling is your word. This is the philosophy, the creed, that drives National Indemnity, or NICO as it's known. So what does that mean? Basically, they believe they can insure pretty much anything, no matter how bizarre or dangerous, as long as they get paid the right price to cover that risk. It's a business built on brilliant, fearless math. And that way of thinking leads to one of the most wild insurance portfolios you will ever see. I mean, we are talking about policies for lion tamers, insuring a $1 billion prize for a perfect March Madness bracket, protecting the Olympics from being canceled, and yeah, even writing massive terrorism policies right after 9/11 when everyone else was running for the hills. So how in the world do you insure a lion tamer without getting, financially eaten alive? The secret weapon is discipline, and that discipline has a name: Ajit Jain. Buffett says Jain has the brains to price any risk, the guts to write a huge check when the price is right, and, this is the most important part, the discipline to walk away from a deal, even a tiny one, if the price isn't right. In fact, get this, GEICO turns down over 98% of the business that comes its way. Now, this whole idea of trust, it's even more critical over at Gen.Re. See, Gen.Re is in the reinsurance business, which is basically insurance for insurance companies. Here, you're making promises that might not get paid out for 50 years or even longer. Your reputation for paying up, it isn't just important, it is literally your only asset. But just like with GEICO, even this giant of the industry lost its way. Berkshire buys it in '98, thinking they're getting this super conservative blue chip company, but then they discover the culture had gone soft. Then 9/11 happens, and it exposes these massive concentrated risks that could have completely bankrupted Gen.Re if it was on its own. It took years, new leadership, and a really painful legal mess to get the company back to its core value of just being earnest and trustworthy. And the price tag for that lost discipline? It was staggering: $6.1 billion in underwriting losses in just 3 years. Now remember that magic insurance float, right? The money you get to hold and invest? It's supposed to be free money. Instead, Gen.Re's float was costing Berkshire billions. I mean, just a catastrophic failure. So, how did they fix this mess? Well, Buffett brought in new leaders and basically told them to do whatever it takes fast. They totally changed how people got paid, tying bonuses directly to how profitable that float was. They hammered home that old-school conservative underwriting culture. And they drilled this powerful idea into everyone's head. Gen.Re has a no-exit strategy. We are in this forever. So every single decision has to be made with that permanent mindset. Okay, so now let's tie this all together. We've got these two totally different models, right? Low cost and high margin. So how do they come together to build that legendary, indestructible castle that is Berkshire Hathaway?
All right, here's the answer to the puzzle we started with. You've got GEICO on one side, low cost, passing savings to you and me. You've got GEICO and Gen.Re on the other, high margin, charging top dollar for their unbreakable promises. But they are both built on the exact same foundation: an ironclad, absolutely non-negotiable obsession with underwriting discipline. You never, ever take on a risk unless the price is right. Period.
And this is the heart of Buffett's famous economic moat concept. It's that lasting advantage that keeps your competitors at bay. For GEICO, that moat is built out of thrift, that structural cost advantage. For GEICO and Gen.Re, the moat is built out of trust, their massive financial strength and their rock-solid reputation. Two completely different materials, but they build the same strong walls. And really, this is the ultimate takeaway, right from the man himself. Buffett calls it an attitudinal advantage. It's a culture, a mindset, where underwriting discipline beats everything else. It beats growth, it beats market share, it beats everything. That attitude, that's the real secret sauce. So as we wrap this up, here's something to think about. When you look at the companies you truly rely on, could be your bank, your car mechanic, your favorite coffee shop, what are the unbreakable promises they make to you? Because as Berkshire Hathaway has shown us, building an entire empire on promises you are fundamentally structured to keep, well, that might just be the most powerful strategy of all. What's a company's reputation really worth? We tend to think of it as this soft skill, right? Something that's just kind of nice to have. But what if I told you it's one of the most powerful financial assets a business can possess? I'm talking about a fortress that you can measure not just in goodwill, but in cold, hard cash. Today, we're going to unpack the real return on investment of reputation. So let's start by jumping back to a time when that fortress was truly put to the test. Okay, I want you to cast your mind back to 2008. The entire global financial system was, well, on its knees. Irresponsible mortgages had absolutely poisoned the market, and one after another, companies that had been pushing these shady loans were just collapsing. Foreclosure signs were everywhere you looked. It was a time of huge financial pain, and the manufactured housing industry was right in the middle of that storm. And yet, in the middle of all that wreckage, one company was completely different. Just look at this. On one side, you've got the rest of the industry. We're talking predatory lending, collapse, the whole mess. And on the other side, you've got Clayton Homes. They didn't just scrape by, they actually thrived. So why? It's because their reputation, which they'd built over years of smart, responsible lending, acted like a financial shield. Integrity wasn't just some moral high ground, it was a business strategy that paid off big time right when everything else was failing. So, how in the world do you build a fortress like that? Well, in our first section here, we're going to look at the blueprint. We'll dive into two very different companies that built unbreakable brands. One was built on a foundation of pure integrity, and the other on an absolutely unforgettable identity. The story of Clayton Homes really starts with its founder, Jim Clayton. And what a story it is, folks. I mean, we're talking about a man born in a log cabin with no electricity who started out working in cotton fields for 25 cents a day. He ran a used car lot to pay for university, even played guitar in honky-tonks. That raw entrepreneurial fire is what led him to take out a $25,000 loan back in '66 to sell mobile homes. And from there, as you can see, he built his business up, launched his own finance company, and eventually took the whole thing public. It's a true classic American success story. But here is the absolute key to it all. Jim Clayton's success wasn't just about his drive. It was about his principles. This quote right here, it gets to the very heart of it. He would criticize his competitors for making it way too easy for customers to borrow money. His solution was something he called a sacred wall between the sales team and the credit department. And it was a simple but powerful rule. You don't approve a loan just to make a sale. That one cultural pillar is what protected his company from the greed that took down pretty much everybody else. Okay, so integrity is one way to build a fortress, for sure, but it's not the only way. Warren Buffett also saw massive value in another company, Jordan's Furniture, which took a completely different path. They built their fortress not on principles, but on pure, unforgettable experience. This place wasn't just a furniture store, it was a destination. The Tattleman brothers, who took over from their dad, came up with this idea they called shop entertainment. And as you can see here, I'm talking about in-store movie theaters, flight simulators, even a replica of Bourbon Street right inside the store. They were brilliant because they understood a huge problem for their customers, families with kids. Let's be honest, shopping for furniture is so boring for children. But at Jordan's, he was a total adventure. This strategy kept the kids happy and busy, which meant the parents could actually relax and shop. And did it work? Oh yeah, just look at this number, $950. That's sales per square foot. To put that in perspective for you, that is a staggering 6 times the industry average. What's so amazing here is how you can just draw a straight line from their unique brand, this shoppertainment idea, to just overwhelming financial success. They created an economic moat, not out of spreadsheets and numbers, but out of pure fun. So, we've seen how you can build a reputation, but what happens when a legendary one starts to crack? The value of integrity can grow and compound for over 100 years, but as we're about to see, it can vanish in a matter of days. Our next story is a real cautionary tale about just how fragile a promise can be, and it's all about the iconic paint company Benjamin Moore. Benjamin Moore was founded way back in 1883 on a set of really powerful principles, which you can see right here. For 130 years, this was who they were: quality, fairness, integrity. Now, a huge part of this was how they sold their paint, exclusively through thousands of independent certified dealers. This wasn't just some sales tactic. It was a deep, deep partnership. People invested their entire lives, their family savings into these dealerships, all built on the promise that Benjamin Moore had their back. And then that promise was tested. After the 2008 recession, sales were shrinking and the company was under some serious pressure to grow. So new leadership came in, and looking for a quick fix, they decided to just throw away that 130-year-old promise. They started negotiating deals to put Benjamin Moore paint on the shelves of big box stores. This completely violated the commitment of exclusivity that Warren Buffett himself had made when he bought the company, a promise he considered sacred. And this quote, wow, it just perfectly captures the human cost. This is from Kim Freeman, one of those independent dealers. You can just feel the betrayal in her words. These people weren't just vendors. They were partners who had built the brand's incredible following through their expertise and personal service. And now they were being dismissed, their life's work just devalued in a hunt for short-term growth. The very foundation of trust that had defined the company for over a century was just cracking apart. The story of Benjamin Moore shows just how fragile a reputation can be. But what if a company's reputation isn't just cracked? What if it's completely destroyed? Our final case study is the most extreme of all, the story of Johns Manville, a company that had to literally rebuild its soul from the ashes of a corporate catastrophe. To really get this story, you have to understand this word, asbestosis. For decades, Johns Manville was a top producer of products that contained asbestos. And for decades, the company knew it was deadly. In fact, the founder himself, Henry Ward Johns, is thought to have died from asbestosis. This wasn't an accident. This was a known danger, a truth they hid from the public and from their own workers. This slide basically lays out a corporate tragedy in 4 acts. For decades, management actively denied the medical risks. Then the lawsuits started piling up, and by 1977, their insurance was completely gone. With a predicted liability of $2 billion, that's twice the company's total assets, they had no choice. In 1982, they filed for what was at the time the largest bankruptcy in U.S. history. Their reputation wasn't just damaged, it was toxic. So the bankruptcy process was, as you can imagine, incredibly complicated. But what it did, essentially, was create 2 separate entities. The ongoing business, which got out of the asbestos industry completely, was shielded by a legal firewall from any future claims. And then separate, independent trusts were set up, funded with company stock, to pay out all the asbestos-related liabilities. This legal separation was the only way the company could even have a shot at a fresh start. And this is the critical point. They had to build a completely new company from the ruins of the old one. This wasn't just moving some money around. It was a deep, painful, and absolutely necessary cultural transformation. That old culture of denial was ripped out and replaced with a new commitment to people, performance, and protection. It took years of hard work of proving that the company's DNA had fundamentally changed. It was only after this decade-long corporate rehab that the company became something Berkshire Hathaway would even consider touching. All right, so we've looked at 4 really different stories: building a reputation, cracking one, and completely rebuilding one from scratch. So what's the ultimate bottom line here? What's the one big lesson we can pull from all of this? This scorecard really sums it all up, doesn't it? First, Clayton Homes proves that integrity isn't just a feel-good thing. It's a strategic asset that pays you back in a crisis. Next, Jordan's Furniture shows us that a truly unique customer experience can build a powerful economic moat that your competitors just can't get across. Then, Benjamin Moore is our stark reminder that trust, even when it's built over 130 years, is so fragile and can be shattered in an instant. And finally, the incredible story of Johns Manville offers us a little bit of hope, that with genuine, top-to-bottom change, it really is never too late to rebuild. So when you pull it all together, the message is crystal clear. Reputation isn't just about PR or making people feel good. It is the ultimate long-term investment. It's the fortress that protects a business when the storms inevitably come, just like it did for Clayton Homes. And if the absolute worst happens, if that fortress is ever breached, that same reputational foundation is the only thing that gives you a fighting chance to rebuild. And that leaves us with one last thing to think about. In a business world that is so often obsessed with short-term profits, with hitting those quarterly numbers, what is the true price of compromising a company's integrity, its identity, its very soul? As these stories show us, the answer is often far higher than anyone can imagine.
Welcome to The Explainer. You know, we hear a lot about family businesses, these incredible companies built on generations of just pure grit and passion. But what happens when that same passion, when it boils over into conflict? That's what we're diving into today, the fascinating reason why so many of these family empires end up finding a permanent and maybe unlikely home with Berkshire Hathaway.
So let's just jump right in with a question that sounds like it's from a movie. Seriously, what happens when a 96-year-old founder just refuses to retire? And not only that, but opens up a rival shop right across the street from her own family. This isn't some hypothetical business school case study. No, this is a real story, and it perfectly sets the stage for everything we're going to talk about. Okay, so this whole story really kicks off with one person, Rose Blumkin. You've probably heard her called Mrs. B. And she wasn't just a founder, she was an absolute force of nature who literally built a massive empire from scratch.
I mean, just look at this timeline. It's incredible. We're talking about someone born in Belarus who was already running a grocery store at 16. She escapes to America right before the Russian Revolution. The story goes she literally talked her way past a border guard and shows up with zero money and not a word of English. I mean, can you imagine? That kind of experience, it doesn't just make you tough, it forges this unbreakable will inside you. For her, survival and building a business were basically the same thing. And by 1937, she's got the Nebraska Furniture Mart up and running right out of her own home.
And this was her secret sauce, right here. It was so simple, but man, was it effective. Sell cheap, tell the truth, don't cheat nobody. That's it. It wasn't some complex business school strategy. Just undercut everyone on price, be honest about it, and you'll build this incredibly loyal customer base. You know, it's actually the same kind of thinking that you see behind other Berkshire giants, like GEICO.
So you can imagine, her competitors were not happy about this. They were furious. They tried everything, getting manufacturers to boycott her, even suing her for unfair trade practices because her prices were too low. But this is where the legend of Mrs. B really shines. Not only did she win the cases, but the story goes that after the judge threw the case out, she sold him $1,400 worth of carpeting. Right there, she turned the courtroom into her own showroom. I mean, that's Mrs. B for you. Okay, but here's where the story takes a turn. Because all those things that make a founder like Mrs. B so incredible, that nonstop drive, that absolute refusal to quit, those very same things can create huge, huge problems down the road for the family and for the business itself.
Yeah, this chart really nails what we're talking about. It's the founder's dilemma. Think about it. The skills you need to build something out of nothing are not always the same skills you need to, pass it on smoothly. That crazy, unrelenting drive, it can just burn out the next generation. That fierce tenacity, it can make it impossible for the founder to ever really let go of the reins.
And for the Blumkin family, this whole dilemma just exploded. By 1989, Mrs. B is 96 years old. Her grandkids, who, by the way, are in their 60s themselves and have been in the business forever, they gently suggest, maybe it's time to retire. But to Mrs. B, that wasn't a nice suggestion. To her, it felt like a total insult, like they were trying to push her out of the very thing she'd built with her bare hands.
So what did she do? Her response was, well, it was classic Mrs. B. No arguing, no big family meetings. She just went right across the street, opened up a competing store called Mrs. B's Clearance, and started going head-to-head with her own family. And she was good at it. She gave the original store a real run for its money.
Look, this isn't some one-off crazy story. It happens all the time in family businesses, just maybe not as dramatically. You see these common crossroads pop up again and again. Maybe the founder just won't let go. Maybe the kids don't want to take over. Or, maybe the family's entire net worth is tied up in this one business and they want to diversify. Or maybe, like with Helzberg Diamonds, the next generation just feels the incredible weight of that legacy. Every one of these businesses hits a point where they have to make a really tough choice.
So where do you go from there? You're stuck at this intersection of business, family, and finance. Well, for a surprising number of these families, the answer turned out to be Warren Buffett.
And here's the first part of what made his offer so different. It's this idea of autonomy. It's almost unheard of when a big company buys a smaller one. Buffett's philosophy is simple. He buys great businesses because he trusts the people who built them. He's not coming in to clean house and install his own guys. He wants them to keep running the show.
And the second piece of the puzzle, and this is probably the most important one for these families, is permanence. You have to understand, Berkshire is not a private equity firm. They're not looking to buy your company, slash costs, and then sell it off in 5 years for a profit. When they buy forever. They're offering a permanent home.
And this is so important to get. For these families, this was never just about the money. Their biggest fear, their absolute nightmare, was watching some new owner come in, dismantle the company they'd spent their lives building, and fire all the people who'd been loyal to them for decades. So Berkshire's promise, it wasn't just a business deal. It was an emotional solution.
But you might be thinking, culture, permanence, that's all soft stuff. Can you actually put a price tag on it? Well, the story of R.C. Willey Home Furnishings is amazing because it shows that yes, you absolutely can.
So R.C. Willey was this fantastic furniture business out of Utah, started back in the Great Depression. When the Child family decided it was time to sell, everybody wanted a piece. I mean, they were hugely profitable, had no debt, the bids were coming in fast and furious, and the numbers were getting really big.
But then something strange happened. They got offers for over $200 million, and they turned them down. Instead, in 1995, they sold to Berkshire Hathaway for just $175 million, which leads to the obvious question, why on earth would they do that?
Seriously, think about it. This is a family known for being frugal, a family that built its business through the Great Depression. Why would they willingly leave a cool $25 million sitting on the table? It doesn't make sense, right?
Well, here's your answer. That $25 million, that was the price. That was the tangible, real-world dollar amount that the Willey family put on giving their company a permanent home. It was the value they placed on Berkshire's culture, on knowing that their life's work and their employees would be safe forever.
And you know what? That trust went both ways. A while later, the CEO, Bill Childs, he wanted to open a new store in Idaho. Now, Buffett was pretty skeptical, mainly because, due to Childs' faith, the store wouldn't open on Sundays, which is a massive day for retail. So Child makes this unbelievable offer. He says, look, I'll pay for the whole thing myself, $9 million out of my own pocket. If the store works, Berkshire can buy it from me at cost. If it fails, the loss is all on me.
And guess what? The store was a monster hit. It did $85 million in sales in its very first year. Buffett later said he'd never seen a deal like that at any other public company. It just perfectly shows the kind of partnership and mutual trust that is the absolute bedrock of the whole Berkshire model.
So when you put all these stories together, what do you see? You see that the Berkshire model provides this really unique solution for family businesses. It helps them solve all those tricky personal problems. Who's going to take over? How to deal with taxes? How to avoid burnout? While at the same time making sure the company itself, the legacy, continues on. You could call it the Berkshire glue. It's made of all these things you can't really put on a spreadsheet. It's real partnership. It's incredible generosity. You had families like the Wolfs, the Hellsbergs, the Bridges, who took millions from their sale and gave it to their longtime employees. It's a rock-solid reputation for being fair. That's exactly why a company like Benbridge Jewelers, already on its 5th generation, decided Berkshire was the right home to make sure there'd be a 6th and a 7th.
And in the end, that's what it all comes down to, right? These stories really make you think. In business and really in life, how do you actually measure the value of a promise that's been kept? Because while the numbers on a balance sheet matter, of course they do, maybe the real, lasting value is in all those things you can't count. Things like loyalty, reputation, and trust.
You know, when we think about Warren Buffett's Berkshire Hathaway, we usually think about the businesses he buys. But what's really incredible are the people who built them from scratch. We're not talking about your typical entrepreneurs who are just looking to flip a company for a quick payday. Nope. These are true masters of their craft. Founders who poured their entire lives into building one thing, brick by painful brick, and wanted to see it last forever. So, what can we learn from these master builders? Let's get into it.
I mean, that sounds completely nuts, right? Almost like something you'd read in a fiction novel. But this is the actual real-life journey of one of the amazing people we're going to talk about today. And his story really gets to the heart of what makes these Berkshire entrepreneurs so special. This obsessive focus, unbelievable grit, and a vision that doesn't just span years, but decades.
All right, so here's our game plan. We're going to meet some visionaries who completely conquered the skies. Then we'll see how 2 totally different products, we're talking kids' clothes and cowboy boots, built these unbreakable bonds with their customers. We're also going to dive into the messy, chaotic history of an American icon. And then, at the end, we'll pull it all together and figure out what the secret sauce really is for these incredible entrepreneurs.
So, a lot of these founders are actually winners of the Horatio Alger Award. And what that means, really, is that they are the living, breathing definition of a rags-to-riches story. These are people who started with next to nothing and built incredible wealth and success in a single generation, just proving that with enough drive, pretty much anything is possible. And this is maybe the most important thing to understand. These founders, they don't just build something and then move on to the next shiny object. No way. They find their one true thing, their one passion, and they dedicate their entire lives to it. They just obsess over this one idea, constantly tweaking it, perfecting it year after year, until they are, without a doubt, the best in the world at what they do. Which brings us perfectly to our first story, Albert Lee Yultze. For him, that one lifelong obsession was aviation. His entire journey is just the story of pure passion and a mission that was literally forged in a single moment of absolute terror. Okay, so get this. It's 1939. Yultze is up in an open cockpit plane training an inspector. During a maneuver, the plane rolls, and his seat completely breaks loose from the floor. To make things 1,000 times worse, his parachute fails to open. He somehow survived, but that moment, it changed everything. He became obsessed with finding a safer way to teach people how to fly. What I love about this timeline is you can just see the sheer grit.
At 16, he's slinging burgers at a stand called Little Hawk just to pay for flying lessons. Then he founds this revolutionary company while he's still working a full-time job as a pilot for Pan Am. And check this out. Even after he takes it public, his goal isn't to cash out and disappear. It's to find a permanent, safe home for his life's work, which, of course, ended up being Berkshire. Just look at that number. $19 million. This is what real commitment looks like. His idea of training pilots in simulators instead of actual planes was incredibly expensive. And that number, that was the cost for a single flight simulator. He was betting the entire farm, again and again, on this vision he had for making the skies safer. So how on earth did he pull it off? Well, he built one of the most incredible competitive moats you'll ever see. First, he went to the plane makers, guys like Learjet, and said, hey, you focus on what you do best, building planes, and let me, the specialist, handle all the training. He even got insurance companies on board, offering discounts, they called them safety bucks, to clients who trained with him. And the funding? He reinvested every single dime, lived off his Pan Am salary, mortgaged his own house, and even convinced huge clients like Coca-Cola to prepay for 5 years of service. He made himself absolutely essential. Okay, so now let's switch gears and look at a different kind of empire. This one wasn't born from a near-death experience, but from cold, hard math. If Al Yelchin was the passionate artist, Richard Santulli was the mathematical genius. He didn't just see a business. He saw an equation that nobody else had even thought to solve. This was Santulli's big idea. See, before NetJets, if you wanted to fly private, you basically had two options. Buy a whole jet, which is just ridiculously expensive, or charter one, which can be a total nightmare to schedule. Santulli came along and created a whole new category. You could buy just a slice of a plane and get all the perks of ownership, but you'd share the cost and all the headaches. And this chart just shows how brilliant it was. He carved out this perfect little niche. He took the guaranteed availability you get with owning your own jet, mixed it with a lower cost of chartering, and created this brand new, really powerful value proposition. It was the absolute sweet spot for big companies and wealthy people who wanted the freedom of a private jet without the massive burden of actually managing one. And this, right here, was his mathematical masterpiece. Using decades of flight data, he figured out exactly how many extra planes he needed in his core fleet to guarantee a jet was always available. So the more shares he sold, the more planes he could buy. The more planes he had, the more reliable the service became. And the more reliable the service, the more customers he attracted. It was this self-powering loop, a flywheel, that just got bigger and faster, creating a huge barrier that no competitor could touch. So we've seen moats built on being the expert and on genius-level math. But you know, sometimes the strongest moat, the one that really lasts, is built on something you can't quite touch, a powerful connection with your customer, a brand that stands for something way more than just a product. I know, it sounds like the beginning of a bad joke, right? But the answer is that both Garanimals and Justin Boots became total icons, not just by selling stuff, but by selling an idea, an identity that just clicked really deeply with their customers. The absolute genius of Garanimals was this simple system of mix-and-match animal tags. But it wasn't really about making life easier for parents, though it did that too. As the famous psychologist Dr. Joyce Brothers pointed out, it was all about empowering the kid. It gave them that I-did-it-myself feeling, that little jolt of independence. The brand wasn't selling shirts and pants, it was selling confidence. And John Justin Jr. did the exact same thing, but with cowboy boots. He didn't just sell the brand, he was the brand. He was throwing parties for rodeo stars. He learned to ride horses just because, as he put it would be good for business. He listened to actual calf ropers and invented a whole new boot just for them, the roper. He was even making custom boots with college mascots on them long before that was a huge thing. He wasn't just building a company, he was building a community. So, did all that work? Oh yeah, you bet it did. During his time leading the company, John Justin Jr. grew its annual sales from a respectable $1 million to a jaw-dropping $450 million. That's what happens when you build a brand that's woven into the very fabric of a culture. All right, our last story is a little different. This isn't about one founder with a clear vision from the very beginning. Instead, it's about what happens when a fantastic idea, in this case soft-serve ice cream, grows so fast and so chaotically that the whole thing nearly implodes, and how a new group of entrepreneurs had to step in and basically build the organization from the ground up. I mean, this quote from an old company veteran just says it all, doesn't it? In the early days, the founders were just selling off rights to territories with absolutely no central plan. Every store owner did whatever they wanted. There was no uniform menu, no system, no strategy whatsoever. It was this huge, sprawling success that was a complete and total mess. This timeline shows one of the weirdest corporate histories you'll ever see. The chaos finally boiled over when a key patent expired and lawsuits started flying. And then something totally wild happened. In 1962, the franchisees themselves, the store owners, all banded together to buy the company and create the central leadership they so desperately needed. They literally built the head for the body. It took another group in the 70s to really finish the job, but it was this incredible bottom-up story that saved Dairy Queen and paved the way for legendary stuff like the Blizzard. So when we step back and look at all these incredible stories, from flying planes to selling boots to scooping ice cream, what are the common threads? What really is the essence of one of these Berkshire self-starters? It really all comes down to this playbook right here. They have a crystal clear vision and the sheer tenacity to see it through no matter what gets thrown at them. They are completely obsessed with their customer, creating things that solve a real problem for a real person. They're not building something just to sell it. They're building it to last forever. And because of that unique approach, they end up building these deep, durable, competitive moats that protect their business for generations to come. You know, the stories of these entrepreneurs are just such a powerful counterpoint to the startup culture we see all around us today. They suggest that real, lasting value isn't created in a mad dash to an IPO. It's built over a lifetime, like a marathon dedicated to a single craft. And it really makes you wonder, in our rush to build the next big thing overnight, have we maybe forgotten how to build something that truly endures? Let's talk about one of the biggest paradoxes in the entire business world. It's a company you've definitely heard of, Berkshire Hathaway. Now, on the surface, it's this corporate giant, right? But when you look at how it's actually run, it seems completely, utterly impossible. Today, we're going to pull back the curtain and figure out just how they do it. Okay, let's start with a number, 24. Take a good look at it. That is the total number of people who work at Berkshire Hathaway's corporate headquarters, the entire global HQ in Omaha, Nebraska. That's it, a team that could barely fill a small conference room. Now, hold that thought and look at this number. Over 300,000. That's how many people work for the hundreds of companies Berkshire owns all over the world. The difference in scale here is it's staggering. It doesn't make any sense. So, that leads us to the one question that this entire explainer is built around. How in the world is this possible? How can a tiny team of 24 people possibly oversee a global workforce of more than 300,000? I mean, it flies in the face of everything we're taught about management. So here's our roadmap for figuring this out. We'll start by defining the paradox itself. Then we'll dive deep into their hands-off philosophy. We'll look at a real-world example with the pampered chef story. Then we have to talk about the inherent risks of all this freedom. After that, we'll see the support system that makes it all work. And finally, we'll get to the heart of it, their culture of trust. All right, let's get into the secret sauce, Berkshire's core ideology. It's a philosophy that is, well, it's so simple, it's radical. And it's built on two really powerful ideas, decentralization and autonomy. And I mean, just look at this comparison. It's like night and day. On one side, you have the Berkshire model. It's all about decentralization, individual autonomy, and a deep-seated trust in people to act like owners. And on the other side, well, that's pretty much every other big company. Bureaucracy, rigid chains of command, endless committees, and layers upon layers of review. It's not just a different approach, it's practically a different religion. And this is the absolute key to understanding them. For Berkshire, autonomy isn't some corporate buzzword they throw around. No, it's a core conviction. It's a fundamental belief that if you put the right people in charge, people with integrity, and you just get out of their way, they will almost always do the right thing and create more value than any micromanaging boss ever could. It's a huge bet on character. So all this theory sounds great, right? But what does it actually look like in the real world, with real people and real money on the line? Well, let's take a look at the pampered chef. This story is the perfect case study because it shows the incredible power of this philosophy and its very real dangers. Just look at these numbers. This growth curve is absolutely explosive. The company started in a basement in 1980 with a tiny $3,000 loan. By 2002, sales were over $700 million. And this wasn't fueled by some massive corporate sales force. Nope. It was driven by an army of tens of thousands of independent consultants. And here's the magic in the model. These consultants, they weren't employees. They were entrepreneurs. They were their own bosses. No fixed hours, no assigned sales territories. The company simply gave them the tools, the products, the recipes, the guidance, and then trusted them completely to go out and build their own businesses. It's autonomy at the grassroots level. And you can tell this wasn't just some PR line. The founder, Doris Christopher, genuinely believed that these independent business people were the company's crown jewel. This idea of empowering people wasn't a strategy. It was the very soul of the company, and it's what fueled that incredible success. But, and you knew about what was coming, right? This much freedom, it comes with enormous risks. A hands-off approach means that when things go wrong, and they do go wrong, you might be the last person to find out. This is the big, high-stakes bargain that Berkshire makes every single day. And they faced an early test of this back in the 90s. Growth was happening so fast that the quality of service was starting to slip. So what they do? They made a move that was completely counterintuitive. They froze all new recruiting. For a direct sales company, that's almost unthinkable. They chose to protect their long-term values and reputation over short-term profits. And in doing so, they earned even more trust from their existing consultants. But that was a pretty small test compared to what was coming. Now we get to the dramatic climax of this story, the David Sokol scandal. You see, Sokol wasn't just some executive. He was a superstar, widely seen as a potential successor to Warren Buffett himself. And his actions were about to trigger a crisis that would shake Berkshire's culture to its very foundations. Okay, let's just walk through the timeline because it really tells the story. In late 2010, Sokol starts eyeing a company called Lubrizol as a potential acquisition for Berkshire. Then, in January 2011, just before he formally recommends the deal to Buffett, he goes out and personally buys $10 million worth of Lubrizol stock. A couple of months later, Berkshire announces the acquisition and Sokol walks away with a massive personal profit. I mean, the timeline is just damning. Now, when this all blew up, Sokol resigned, but he was completely defiant. He insisted he'd done nothing wrong. And at first, Buffett put out this surprisingly mild press release that even included Sokol's defense. That did not go over well. The public went crazy. It really looked like Berkshire was just giving a pass to one of its own. But then came the reversal. A full-blown audit committee report came out, and it was clear Sokol had violated company policy, specifically the most important policy of all, guarding Berkshire's reputation. And that's when Buffett's tone changed completely. At the next annual meeting, he publicly called Sokol's actions inexcusable and inexplicable. The trust had been shattered, and the hammer came down hard. So the Sokol affair was this massive black eye. It exposed just how vulnerable this model of trust can be. But it also shows something deeper. At Berkshire, hands-off does not mean hands-washed. It is actually a really powerful support system and a clear set of principles holding everything together. For a great example of this, let's go back to Pampered Chef one more time. In the early 2000s, some activists started boycotting the company because of a charity program Berkshire had. Now, these boycotts were starting to hurt the livelihoods of those thousands of independent consultants. So what did Berkshire do? To protect them, they canceled their own very popular charity program. It shows that this autonomy thing is a two-way street. The parent company is deeply committed to supporting the people it trusts, and these are the guardrails. Every couple of years, Buffett sends a letter to his CEOs with just 6 simple but incredibly powerful rules. And look at number 1. That's the whole ballgame. Guard Berkshire's reputation. The rest are basically common sense. Tell me bad news early. Let's talk about huge checks. Think long-term. But outside of these few rules, the CEOs are completely free to run their businesses. It's freedom, but within a very clear framework. So, let's bring it all home. Let's get to the final verdict. When you put the explosive growth from autonomy on one side of the scale and the profound reputation-threatening risks like the Sokol affair on the other, where does that leave us? Is this culture of trust a brilliant success, or is it a dangerously flawed liability? Well, Charlie Munger, as usual, cuts right through the noise. His argument is that the best way to ensure compliance isn't to build huge legal departments and write 1,000-page rulebooks. It's to hire incredibly trustworthy people in the first place, and then you actually trust them. He loves to point out that the places with the biggest compliance departments, like Wall Street, seem to have the most scandals. For Munger, this culture of trust is simply what works. And this, right here, this is the iron fist inside the velvet glove of autonomy. Buffett's famous line makes the ultimate priority absolutely crystal clear. You can make a business mistake. You can lose money. That happens. But if you damage the company's reputation, even a little bit, there is no forgiveness. The autonomy is a gift, but the duty to protect the firm's integrity is absolute.
So what this all leaves us with is a really provocative thought. Berkshire's model is a complete outlier. It bets everything on trust in a world that seems to be running as fast as it can toward more oversight and more control. And it forces us to ask a really tough question about our own jobs, our own companies. In our rush to prevent the next mistake, how much creativity, how much speed, and how much value have we already lost simply by not trusting the right people enough?
All right, let's dive in. We're about to peel back the layers on one of the most successful business empires ever built, Berkshire Hathaway. We're going to deconstruct the core principles, the playbook, that turned a bunch of seemingly random companies into an absolute juggernaut worth $500 billion. Let's get to it.
$46 billion. Now, that is a staggering number. And it's the annual revenue of just one of Berkshire Hathaway's companies, a grocery wholesaler you've probably never heard of called McLane. So how on earth does a single company get that big? Well, it's not really about selling snacks and drinks. It all comes down to a powerful philosophy, a kind of smart, disciplined, long-term thinking that we're going to call investor savvy.
So that leads us right into our first pillar, what we'll call the accretive growth engine. Now, forget about those flashy, high-risk bets you see in the movies. This is the opposite. It's about the slow, steady, relentless reinvestment of your profits, year after year, decade after decade. It's about building your empire brick by boring brick, not by swinging for the fences. And there's no better example of this than the McLane Company itself.
Just look at this timeline. It's an incredible lesson in patience. This was absolutely not an overnight success story. Robert McLane starts a little shop in 1894. A huge innovation for them, back in the 20s, was just getting trucks. It took them more than 50 years, surviving the Great Depression, a world war, just to hit $1 million in sales. But all that slow and steady work built a rock-solid foundation that let them explode to $1 billion in the next few decades.
Okay, so how did they actually do it? How did they scale? Well, they had this brilliant, deceptively simple playbook. They'd roll into a new region, build a distribution center, and just start pushing their trucks out further and further. Once business got busy enough in one of those new spots, boom, they'd build another center right there. Rinse and repeat. They ran this exact play a dozen times until they'd covered the whole country. It's just a masterclass in methodical, intelligent growth.
Well, all that success eventually got them noticed by a really big customer, Walmart. Walmart bought them in 1990, and yeah, growth absolutely exploded. But a weird problem popped up. Competitors like 7-Eleven were kind of hesitant to buy their supplies from a company owned by their biggest rival, right? So when Berkshire took a look at McLane in 2003, they spotted this hidden gem, a huge, untapped market that would open up the second McLane wasn't owned by Walmart anymore. And boy, were they right. And that leads us perfectly into our second pillar. See, once a business is throwing off a ton of cash, you've got two choices. You can reinvest it in yourself like McLane did for decades, or you can use that cash to buy other great companies. This is all about acquiring smarter, not just getting bigger for the sake of it. It's the art of a deal, Berkshire style. In Berkshire's world, they really have two main moves. The first is what they call a bolt-on acquisition. Think of it like buying a direct competitor. It just makes your core business stronger. The second move is a tuck-in. That's when you buy a company in a related field. You're adding a new skill to your toolbox without wandering off into something you know nothing about. Let's see how these actually work in the real world. So, let me put you in the hot seat for a second. Imagine you're the CEO of a company that makes some, weirdly specific but super important industrial part. You want to sell your company to Warren Buffett, but you're almost certain he has absolutely no clue what your product even is. What's your move? What do you do?
Well, back in 2001, a CEO named Gene Toombs from a company called M.I.T.E.C. had this exact problem. And his solution? It was genius in its simplicity. He just sent Buffett an overnight package. Inside, a letter, and one of these little 3x5-inch metal plates used to build roof trusses. Buffett himself called it an unprepossessing chunk of metal and said he couldn't imagine its function. But as soon as he understood how this one little piece of metal was essential to basically the entire home-building industry, he got it, and Berkshire bought the company.
And here's where it gets really mind-blowing. M.I.T.E.C. itself turned into an acquisition machine, doing over 40 of its own bolt-on deals. For example, M.I.T.E.C. bought a company that makes anchoring systems. Then that company, now a part of M.I.T.E.C., started making its own bolt-on acquisitions of its rivals. You see what's happening? The skill, the capital, the entire mindset of smart acquisitions cascades down through the whole organization.
Okay, so that's a bolt-on. Now let's talk about a tuck-in, with the story of Lubrizol. By the late 80s, these guys were a huge player in petroleum additives, a solid, very respected company. But they were stuck. The industry was mature, and their growth just flatlined. I mean, for 16 straight years, net income went nowhere. They were a sleeping giant, just waiting for someone to wake them up.
And then a new CEO, James Hambrecht, came along with this game-changing vision. He looked at the company and realized, wait a minute, our real skill isn't just making engine oil better. Our superpower is the science of making specialty chemicals stick to really difficult surfaces. His strategy? Let's use that superpower on everything. Human hair, paint, even paper money.
To make that vision a reality, he made a huge tuck-in acquisition. In 2004, Lubrizol bought a company called Novion. Now, Novion didn't know anything about engine additives, but they were world-class experts in polymers for things like skin creams and industrial paint. It was the perfect fit. It wasn't just about adding revenue. It was like buying a whole new brain for the company, instantly rocketing them into totally new markets.
And this quote from the CEO just says it all. He said the Novion deal was an oh my gosh moment. You can feel the shockwave it sent through the company. It was a clear signal to everyone, both inside and outside the company, that the old sleepy Lubrizol was gone for good. But here's the part that is so crucial. Investor savvy isn't just about the deals you make. It's about the ones you don't make. A few years later, Lubrizol wanted to buy another company. They put in the highest bid, almost $4 billion. But when the sellers tried to start a bidding war to get more money, Hambrecht just walked away. He refused to get emotional and overpay, even if he meant he lost. That discipline is the absolute hallmark of the Berkshire way.
Now, you might be thinking, how do you get your managers to have that kind of incredible discipline? You can't just send out a memo. It requires a really specific kind of corporate culture. And that brings us to our third and maybe most important pillar, the autonomy advantage. This is the secret sauce that makes the whole thing work. You see, Berkshire Hathaway is not some top-down command and control organization. It's a deeply decentralized empire that is built on one thing: trust. Just think back. Each of McLean's distribution centers runs like its own little company. Mitek has its own M&A team and doesn't have to get permission from headquarters for every deal. And maybe the most telling detail of all, the CEOs of these companies are responsible for finding their own successors. That's an incredible amount of trust. This quote from Tom Menenti, the CEO of Mitek, just says everything. This guy was lured out of retirement to take the job. He'd said no to a bunch of other offers, but he came back for this one. Why? Because he knew he'd have total autonomy. And he makes a critical point here. Because Berkshire treats him with that much trust, it makes it easy for him to turn around and treat his own people the same way. The culture of empowerment just flows downhill. So we have these three big pillars: accretive growth, smart acquisitions, and radical autonomy. The question is, how do they all fit together? Well, they don't just exist side by side. They create a powerful, self-reinforcing loop, a concept that's often called a flywheel.
Here's how that flywheel spins. Step 1. You give talented managers autonomy, and they run their businesses really well, generating a lot of profit. Step 2. Some of those businesses, like the famous See's Candies, become cash machines. They make way more money than they can possibly reinvest in just making more candy. Step 3. All that extra cash gets sent up to Berkshire headquarters. Then, and this is the magic, Step 4. Berkshire's job is to intelligently redeploy that capital to other companies in the family that can use it to grow and make smart acquisitions. Capital flows to where it can be used best. Period.
And if you want to see the ultimate expression of this flywheel, you have to look at Berkshire Hathaway Energy, or B.E.R.K.H.I.R.E. Think of B.E.R.K.H.I.R.E. as this massive engine designed specifically to absorb billions and billions of dollars from the flywheel and deploy it into huge strategic deals in the energy industry. It is the flywheel operating at absolute maximum scale. And the numbers? Well, they speak for themselves. This chart is just showing the value of acquisitions done by the subsidiaries on their own. In 2012, they deployed $2.3 billion. The very next year, that jumped to $3.1 billion. This flywheel isn't just a cool theory you read in a business book. It is a real-world capital allocation machine, and it's actually accelerating.
So there you have it, accretive growth, smart acquisitions, and radical autonomy. These aren't just abstract ideas, they are the interlocking gears that built one of the greatest companies in the world. And the final question isn't just for CEOs. Whether you're building a business, managing a team, or just building your own investment portfolio, which of these incredibly powerful principles could you start using?
All right, let's dive in. Berkshire's secret, the power of being boring. You know, we're going to pull back the curtain on one of the biggest investment empires on the planet, Berkshire Hathaway. And we're going to find out that the secret to its mind-boggling success is actually something incredibly simple. So here's a thought for you. What if the secret to building a massive empire is just to be boring? I mean, think about it. We live in a world that's just obsessed with disruption, right? Always looking for the next big thing. So this idea, it feels almost wrong, doesn't it? But what if real, lasting success comes from doing the exact opposite? Well, Berkshire Hathaway's story, it makes a pretty powerful case that sometimes boring is brilliant. Okay, so you've definitely heard of some of their companies, right? GEICO, Dairy Queen, they're household names. But here's the thing. The real engine of Berkshire is this huge collection of companies that, well, you've probably never heard of. Flight Safety, Lubrizol, Mytech. Who are these guys? They're in these really basic industries: energy, transportation, chemicals. And that difference between the famous brands and the unknown workhorses, that's the key to understanding everything about them.
So here's our game plan for today. We'll start with the unseen empire. Then we'll get into the rudimentary rule. We've got 3 case studies to look at: the railroad, the carpet, and the underwear. And finally, we'll wrap it all up with the wisdom of simplicity. All right, first up, the unseen empire. You know, when you actually look at what Berkshire owns, it's kind of wild. It's everything from ice cream to industrial chemicals. So you gotta ask, right? What's the connection? What's the big idea that holds all this stuff together? Well, the answer, it's surprisingly simple.
And that common thread, we're calling it the rudimentary rule. Now, I know what you're thinking. Rudimentary sounds, well, a little insulting, doesn't it? Like it means basic or not very smart. But for Berkshire, choosing the rudimentary path isn't a weakness. It's actually a huge strategic advantage, and a very deliberate one.
So what is a rudimentary business? Well, it's all about what you might call institutional permanence. Just think about it for a second. We've needed energy, transportation, and clothing for hundreds of years, right? And we're probably going to need them for hundreds more. This isn't about being scared of new tech, not at all. It's about preferring businesses that are like part of the fundamental fabric of civilization. They're not going anywhere. And this really shows you the trade-off they're making. On one hand, you've got the new economy. It's exciting, it's flashy, it's like a rocket ship. The potential payoff is huge for sure. But man, you have to keep feeding the beast, constantly changing just to keep up. Then you have the old economy. Think of it like a castle with deep, strong foundations. It's way easier to understand, it's shielded from all that crazy tech disruption, and you're not wasting a ton of money chasing every new fad. And this right here, this quote is everything. It's the foundation of their entire worldview. Think about that. For them, rule number 1 isn't how do we get rich quick. It's how do we absolutely, obsessively make sure we don't lose money. It's a totally defensive way of thinking, and it explains exactly why they love these simple, durable, rudimentary businesses. Okay, so let's see how this all works in the real world. Our first case study, the railroad company BNSF. This is a fascinating story about an ancient industry that was forced to completely reinvent itself, and it perfectly illustrates the lesson of permanence. So, railroads. I mean, they've been a backbone of the US economy since like the 1850s, but for a huge chunk of the 20th century, the government had them on a tight leash with price controls. It basically suffocated the industry, leading to this huge crisis in the 70s. But the big moment, the one you gotta remember, is the Staggers Act in 1980. It deregulated everything, and it was like a dam breaking. Suddenly, everything had to change. Before that act, the whole culture was just stuck. It was command and control, almost militaristic. The only thing that mattered was cutting costs. Employees just thought their job was to run trains. That's it. But after deregulation, the entire game changed. All of a sudden, they had to think like entrepreneurs. They had to actually care about customers and making money on their investments. And one of the companies that would later become BNSF, called BN, they really led the way here by bringing in managers from totally different industries. And you want to see proof of this culture shift? Look no further than safety. The old railroad world was this dangerously macho place. And BN, They had the worst safety record in the entire industry. It was terrible. So management started a revolution. They stopped talking about safety as just a bunch of annoying rules. Instead, they framed it as a massive financial problem. They banned dangerous old traditions, brought in modern training, and, this is the brilliant part, they rewarded the safest teams with company stock through something called the 2.5 Club. And just like that, they went from the absolute worst to the absolute best. It saved them billions, and more importantly, it saved countless lives. So then, in 1995, things get even more interesting. BNN merges with a rival, Santa Fe, and their cultures, oh man, they just slammed into each other. It really boiled down to two completely different ideas about people. Santa Fe's management basically believed people were, inherently bad, and you needed a tough, military-style system to keep them in line. But BNN believed people were inherently good, and you just had to give them the right environment. Trying to mash those two worldviews together into one company, well, that was an epic challenge, and pulling it off was one of their greatest wins. Next up, let's look at Shaw Industries, the world's biggest carpet manufacturer. Their story isn't about adapting to outside forces. No, it's more of a cautionary tale, a story about a great company that lost its way and had to relearn the critical lesson of focus. So think about it. How do you win in a business like carpets? I mean, it's a commodity, nobody is really loyal to a carpet brand. Shaw's answer was simple, but they were absolutely relentless about it. Just be the cheapest, be the low-cost producer. They built this incredible moat around their business by controlling every single cost. They even started their own trucking company just to get a tiny edge on delivery. But then, in the mid-90s, they just lost their way. They made two massive mistakes. First, they launched this complicated branding thing that nobody understood. But the second one, that was the real disaster. They decided to buy hundreds of retail stores. Think about that. They went into direct competition with their own customers, the people who sold their carpets. The backlash was insane. Their clients, we're talking huge companies like Home Depot, were absolutely furious. They just dropped Shaw. It was a complete, self-inflicted disaster. So the company basically hit rock bottom. The stock was in the tank, their reputation was ruined. The founder, Bob Shaw, he had to get up in public and just admit they screwed up. He announced a total return to basics. They sold off all those retail stores, they ditched all the other distracting projects, and they put every ounce of energy back into the one thing they were the best in the world at, being the most efficient, low-cost carpet maker on the planet. Okay, our last case study brings us a lesson in financial prudence, taught by one of America's most iconic brands, Fruit of the Loom. This is the story of how a great business can be brought to its knees, not by a bad product, but by a bad balance sheet. I mean, just look at this timeline. Fruit of the Loom is a true American icon, right? It goes all the way back to 1851. For more than 100 years, it was just success after success. But then, 1985 happens, and that amazing story just comes to a screeching halt. The company gets bought out in what's called a leveraged buyout, which is basically a fancy way of saying it got buried under a mountain of debt. And only 14 years after that, this legendary brand was completely bankrupt. And this is the number that killed them. Over $1 billion in debt. $1 billion. And here's the crazy part. This wasn't debt they took on to build better factories or create new products. No, it was just paper shuffling, pure financial engineering. And it left the company so incredibly fragile that the second things got a little tough, the whole thing just shattered. And here's the real cost, the human cost. To try and pay off that $1 billion debt, they had to do some drastic things. They shut down their plants in America, moved everything overseas. Almost 11,000 people in the US lost their jobs. The Fruit of the Loom brand was still great. People still loved the product, but the company's finances were just fatally flawed. In the end, it was that financial complexity that destroyed a great American business. So a railroad, a carpet company, and an underwear maker. Kind of random, right? But these three really basic businesses each teach us something powerful. So let's tie it all together and talk about the wisdom of simplicity. So here it is. This is the whole framework in a nutshell. From the railroad, BNSF, we get the lesson of permanence, value industries that are just going to be around forever. From the carpet maker, Shaw, we get the lesson of focus. Know what you're good at and don't get distracted. And from the underwear company, Fruit of the Loom, we get the lesson of prudence. Keep your finances simple and stay out of debt. Permanence, focus, and prudence. Those are the three pillars. That's the rudimentary rule.
And that really leaves us with one big question to chew on. We live in a world that just worships innovation, that's always chasing the new thing. But is it possible that the most powerful strategy of all isn't any of that? Maybe it's just the hard, unglamorous work of mastering the boring, essential fundamentals. Something to think about. Thanks for joining me.
All right, let's talk about a business philosophy that's, well, it's totally unique. It's like a sanctuary in the pretty cutthroat world of corporate takeovers. We're going to explore how one company became this final, permanent home for businesses that were just lost, adrift, and basically treated like orphans. And believe it or not, this whole story kicks off with a 5-day-old voicemail. So picture this. You're coming back to the office after the holidays, you're slogging through all the emails, and you finally get around to checking your voicemail. That's exactly what Jim Weber, the CEO of Brooks Running Shoes, was doing in January 2012. And there it was, a message nearly a week old from maybe the most famous investor on the entire planet. Weber was absolutely mortified he hadn't called back sooner, but that one little message, it was about to change everything for his company. Okay, so here's our game plan. We're going to start with that incredible phone call. Then we'll really unpack this problem I like to call the corporate orphan. From there, we'll see how Berkshire Hathaway offers a pretty unique solution, a permanent home. And we'll get into the amazing stories of Brooks and other companies that found a safe harbor there. And finally, we'll talk about the real power behind all this long-term thinking. So when Jim Weber finally gets Buffett on the phone, the man doesn't waste any time. He gets right to it. He starts asking about Brooks Sports and its parent company, Fruit of the Loom, which, by the way, was also owned by Buffett's Berkshire Hathaway. He wanted to know, how connected are you guys? How many services do you share? It seemed like a simple question, but the implications were huge. And this was the heart of it, right here. What Buffett was really asking was whether Brooks, which was buried 2 corporate levels deep, was being held back. He was basically offering Weber the chance to break free, to report directly to him, and to just run his own show without anybody getting in the way. Now, for a company with an incredibly long and chaotic history, this wasn't just some restructuring, it was a lifeline. And to really get why that offer was so powerful, you first have to understand this whole concept of the corporate orphan. It's what happens to a perfectly good, solid business when it just gets passed around from one owner to the next. See, each new parent company has a different strategy, a totally different agenda, a different timeline, and it leaves the company with no stable identity, no real long-term vision. And wow, this slide just perfectly illustrates the chaos Brooks had to live through. Just look at this journey. In a little over 2 decades, it had 5 different corporate owners. It was bought out of receivership, sold to a Norwegian private equity firm, then sold again to a Connecticut private equity firm, then acquired by a bigger corporation, which was then acquired itself. Just think about that. Every few years, a brand new boss, a brand new plan. All this constant change created what you can only call a painful strategic whiplash. One owner, Wolverine Worldwide, pushed Brooks to go from being a niche brand to this mass market generalist trying to go head-to-head with giants like Nike. Yeah, that didn't work. So the next owner tried to slam it in reverse, going back to class from mass, focusing on high-end shoes for serious runners. This constant back and forth meant the company could never, ever commit to a vision and really build momentum. All right, so that's the problem. Now let's look at the solution. Because Warren Buffett and Berkshire Hathaway, they represent a completely different way of thinking about ownership. They aren't foster parents just looking to flip a company for a quick buck. They offer something that's pretty radical in today's market, a permanent home. And this is the core idea. Berkshire buys companies with the plan to hold them forever. And this gives them 2 things that these corporate orphans are just starving for: stability and autonomy. It's a sanctuary, a place where good businesses are safe from the whims of Wall Street. One writer put it perfectly. He called it a boys' town for business, a place of refuge. Now this slide, this is what's really interesting because it just lays bare these 2 completely opposing philosophies. You've got the typical private equity model, which is all built around a short-term exit. They pile on a ton of debt to buy the company, they meddle in the operations looking for synergies, and their eyes are always on polishing it up for the next sale. Berkshire is the polar opposite. It's a permanent home, no debt is used to buy it, managers are trusted to run their own companies, and the focus is on a 50-year horizon. It's 2 different worlds. So you might be asking, does this model actually work? Well, let's look at the proof. We'll start with what happened to Brooks after Jim Weber took Buffett up on his offer, and then we'll see how this same pattern has played out for other corporate orphans who finally found their way to Berkshire. So once he was freed from all those corporate layers above him, Weber finally had the autonomy to go all in on the vision he'd always believed in. He doubled down on that niche strategy, focusing only on making high-end performance running shoes for serious runners. He even cut the cheaper lines, which actually caused a dip in revenue at first. But he just knew, it was the right long-term play. And you know what? His courage totally paid off. After taking that initial hit, the focus strategy proved to be the right one. Weber showed that even inside a chaotic ownership mess, a great leader with a clear vision could make it work. Within a few years, even before Buffett's call gave him total freedom, revenue had already climbed back to a really solid $69 million. But that $69 million, that was just proving the concept. The real story, the mind-blowing part, starts after Buffett's call. Once Weber was truly let loose in 2012, completely free from any corporate interference, the growth was just explosive. With the stability and the confidence that can only come from a permanent home, sales went through the roof. By 2013, just 1 year after that phone call, sales hit nearly $500 million. And the thing is, the growth just kept going at this blistering pace, putting Brooks on a clear path to $1 billion in sales. The stability that Berkshire provided unlocked so much value that the Brooks division alone became as valuable as the entire Russell Corporation that Berkshire had bought in the first place. Think about that. And this incredible turnaround, it's not just some one-off story about a shoe company. Brooks is the perfect example of a much bigger pattern. Berkshire is home to at least 7 major companies across totally different industries, from making RVs to selling party supplies to distributing electronics, that are all former corporate orphans. They all went through that same chaotic journey before finding their final home. Let's look at a couple of their stories because they are pretty dramatic. Okay, get this story about Forest River, the RV maker. It's like something out of a movie. The founder, Peter Leigel, he gets fired from his own company by these leverage buyout guys who had buried it in debt. Then the company goes bankrupt. But Leigel, this guy's a true survivor. He doesn't give up. He buys back the assets himself and rebuilds it from the ashes. So when it came time to find a partner, he was so scarred by that experience, he refused to go back to that world. So what does he do? He sends a simple 2-page fax directly to Warren Buffett, explaining why his company was different. Buffett saw the value in a business run by a proven, resilient founder, and they had a deal in a week. Or how about Oriental Trading, the party supply company? It's another textbook victim of the private equity playbook. It was passed from one firm to another, loaded up with so much debt that it eventually just collapsed into bankruptcy. When the company clawed its way back, its leaders had learned a really tough lesson. Their one and only goal was to find a permanent, stable home. They went looking for Berkshire, making a clear choice that securing the company's future was way more important than just squeezing every last penny out of a sale. And you know, maybe no story makes the motivation clearer than this quote from Buffett. He's talking about Paul Andrews, the founder of the electronics distributor TTI. Andrews saw what happened to other companies after their founders died. The chaos, the auctions, a lifetime's work getting dismantled by total strangers. He just decided, nope, not gonna happen to my people. He went out and found Berkshire specifically to protect his employees and his legacy from that exact fate, turning down other buyers who would have just flipped the company in a few years. So when you step back and look at all these stories, Brooks, Forest River, TTI, a really clear picture starts to form. The real magic of the Berkshire model, their secret sauce, it isn't some complex financial trick. It all just boils down to the simple but incredibly profound power of permanence. Thinking with a 50-year horizon, man, it just changes the whole game. It gives great managers like Jim Weber the freedom to make smart, long-term investments without having to worry about the next quarterly earnings report. It builds a culture that's based on trust, not on micromanagement. And maybe the most important thing of all, it acts like a magnet, attracting founders who care more about their company's future than they do about cashing out. That is Berkshire's true unfair advantage. And it's really important to understand what Berkshire is not doing here. They are not turnaround artists. Buffett has famously said that when a great manager takes on a bad business, it's usually the bad business that wins. So Berkshire doesn't buy broken companies. It buys excellent companies run by excellent people who are just stuck in a broken system of ownership. So at the end of the day, that's the secret. The companies that find their way to Berkshire, they're already survivors. They've already proven how resilient they are by living through serial owners, crushing debt, and even bankruptcies. Berkshire just gives them the one thing they've never, ever had, a stable foundation. By giving them a final home, it removes that constant threat of being sold again and just unleashes their full, untapped potential. It's a really powerful model, and it leaves us with one last big thought. Our whole modern economy is obsessed with speed, disruption, quarterly returns. But the story of these corporate orphans shows us there's just immense value in patience and stability. So it really makes you wonder, in our rush for short-term results, what do we lose by forgetting how to build for eternity? There's this question, a huge one, that hangs over pretty much every great company ever built. It's all about legacy, about what comes next, and really about survival. And that question is, really think about it. What happened to Apple after Steve Jobs? Microsoft after Bill Gates? When you have an organization that's basically the product of one person's vision, how in the world does it keep going, let alone thrive after they're gone? It's got to be one of the hardest problems in business. And today, we're going to dig into a story, a kind of obscure one, that might just hold the answer for the biggest of them all, Berkshire Hathaway. Okay, so let's do a little thought experiment. I want you to imagine you're a Wall Street analyst, and it's, say, the mid-90s. Someone drops a stack of financials on your desk for this massive conglomerate. We're talking hundreds of companies, everything from transportation parts to industrial pipes. Nothing sexy, no flashy tech stuff, just boring old-school businesses that happen to be absolute monsters in their fields. And for the last 40 years, the whole thing has been run by two guys, two aging, brilliant billionaires who make all the big calls. So here's the question for you, the analyst. What happens when they're gone? Does this whole thing just fall apart? Well, this wasn't just a hypothetical. This was the real-life puzzle facing anyone looking at a company called the Marmon Group. This was the private empire of the Pritzker brothers, Jay and Bob. And back then, the consensus on the street? Oh man, they thought it was doomed. Too big, too complicated, and way too dependent on the two brothers. The prediction was that once they left, the whole thing would just crumble. But here's the kicker. They were dead wrong. And the story of why they were so wrong, well, that's what makes this whole thing so fascinating for us today. See, the Pritzker brothers, they were like the perfect tag team, a true case of complementary genius. You had Jay, the deal maker. He was the finance whiz, a lawyer who could look at a balance sheet and, a lot like Warren Buffett actually, see the entire story of a business. He could structure a deal like nobody's business, basically creating value where no one else saw it. And then you had his brother, Bob. He was the operator, the nuts and bolts guy. He was an industrial engineer, the kind of person who could walk onto a factory floor, listen to the machines, and just know what was wrong. And he knew exactly how to fix it. So you had one brother finding the deals and the other making sure they actually worked. And their playbook, it was so simple, it was almost beautiful, but man, was it powerful. Here's how it went. Step 1, Jay finds a struggling company and buys it, usually for a bargain, sometimes less than what its assets were worth. Step 2, Bob comes in. And this is key. He didn't just clean house. Nope. He'd work with the managers who were already there, the people who actually knew the business, and they'd fix the operations together. They'd be like surgeons, cutting out the parts of the business that were bleeding money and then pouring all their attention, all their capital, into the parts that were strong. And once that company was fixed up and running smoothly, they'd just do it all over again. It was this incredible, relentless engine for growth. But here's what you've got to understand. These guys were not the greed is good corporate raiders from the 80s. Not at all. They weren't buying companies just to chop them up and sell off the pieces for a quick buck. Their whole philosophy was buy, fix, hold. They bought companies to keep them. They saw ownership as a forever thing. When they bought your business, it was a promise that they were in it for the long haul, to invest in it and make it stronger. And man, that built up so much trust. If you were a family business owner looking for a good home for your company, these were the guys you called. But as they got more and more successful, the skepticism actually grew. Marmon just kept getting bigger and bigger, sprawling across all these different industries that had nothing to do with each other. And analysts started scratching their heads, thinking, how can this possibly last? The whole empire just seemed to be held together by the magic of these two brothers. This quote here really nails the sentiment at the time. Everybody was thinking, there's no way this thing survives without Jay and Bob. The second they're gone, this whole complex machine is just going to fly into a million pieces. And then it happened. The thing everyone was worried about. Jay Pritzker passed away in '99. A few years after that, in 2002, Bob retired. This was it, the moment of truth. Was it all going to collapse? Well, look what happened. Nothing. The company didn't even stumble. Leadership passed smoothly to a guy named John Nichols, and then to Frank Black. Now, these guys weren't rookies. They were heavy hitters from another Chicago powerhouse, Illinois Tool Works. And a little while after that, someone very famous started very close attention. So this new leadership team from ITW, they brought a secret weapon with them, a management philosophy that would be absolutely critical for Marmon. It's called the 80-20 principle. You've probably heard of it. The basic idea is super simple. In pretty much any situation, 80% of your results come from just 20% of your efforts. It's all about figuring out what that critical few is and then just focusing on it like a laser. And in a real-world business, what these guys, Nichols and Plack, found, first at their old company and then at Marmon, was that, about 80% of the profits were coming from just 20% of their customers, or 20% of their products. So what did they do? They identified that golden 20% and just poured everything into it. Their best people, their time, their money. They focused with surgical precision on the things that actually moved the needle. And the other 80%? They didn't ignore it, but they managed it way more efficiently. It was this brilliant way to take a huge, complex company and make it simple by just focusing on what really, truly mattered. So what was the result of all this? Well, it was undeniable. All those critics, all the analysts who had predicted disaster, they weren't just a little bit wrong, they were completely, spectacularly wrong. Marmon didn't just survive without the Pritzker brothers. It actually started a brand new chapter of growth and success. And hey, don't just take my word for it. The numbers tell the whole story. Just look at these figures, all from after the Pritzkers were gone. Between 2006 and 2012, the company's net worth jumped from less than $5 billion to almost $7 billion. And revenue and income, rock solid. They even sailed right through the 2008 financial crisis without much of a scratch. This place was built to last. Okay, so let's just hit the pause button for a second and recap. You've got this huge, sprawling company, a collection of boring but really good businesses. It's been run for decades by a couple of legendary aging geniuses. And for years, the outside world has been asking the same question over and over. What's going to happen when they're gone? Sound familiar? Does that remind you of anyone? Of course it does. This is the exact same story, the exact same challenge facing Berkshire Hathaway today. The whole question of what happens after Warren Buffett and Charlie Munger. The parallels between Marmon and Berkshire are just uncanny. It's actually no surprise that Buffett himself saw this, and he did something about it. So, what was the secret sauce? How did Marmon do it? When you really dig in, you realize it wasn't just some new management trick. The real reason was the culture. They had this incredibly strong culture that looks almost exactly like Berkshire Hathaway's. Think about it. Both of them are famously cheap, with these tiny little head offices. At both companies, a handshake is a binding contract. Both give their managers almost total freedom to run their own shows. And, most importantly, they both buy businesses to keep them forever. They're into boring, essential stuff, not the latest fads. And that shared culture, that's exactly why, back in 2008, Berkshire Hathaway went out and bought a huge chunk of Marmon's. See, Buffett knew Jay Pritzker. He'd been watching him for decades. The deal was for $8 billion, and it got done ridiculously fast. No haggling, no army of lawyers crawling all over the books. Why? Because Buffett didn't need to. He already knew the company inside and out. He knew their DNA was the same as his. And it wasn't just the company culture. It went all the way to the top. The guys running the show. The Pritzkers were just like Buffett and Munger. They were obsessed with knowing what they didn't know, staying inside their circle of competence. Jay did deals. Bob did operations. They never strayed. They were incredibly patient, willing to wait years for the perfect pitch. But when it came, they swung for the fences, fast. And through it all, they just had this cool, common sense rationality, something you just don't see very often. Okay, now let's be real. The comparison isn't 100% perfect. There were some big differences. For one, the Pritzkers loved a good turnaround. Buffett, he famously hates them, says they rarely work. Marmot would also sometimes get into a hostile takeover fight. Berkshire would never do that. They're always the friendly white knight investor. And yet, Marmot was a private family-run thing, while Berkshire is this giant public company. So yes, there are differences, but they don't really change the fundamental point about the culture. Which really brings us to the main event, the big takeaway here. Marmon's survival wasn't a fluke. It wasn't an accident. It happened because the Pritzker brothers had spent decades building this incredibly powerful, decentralized culture. A culture built on trust, on giving people freedom, on thinking for the long term. It was a culture so strong, it was bigger than they were. The new guys who came in didn't have to rebuild anything. They just had to take care of that culture and maybe sharpen it a little with tools like 80-20. And this quote, this just sums it all up perfectly. A top exec at Marmon said this, but you could totally imagine Warren Buffett saying the exact same thing. Neither of these companies has some grand, top-down, 5-year strategic plan from corporate headquarters. That's not how they roll. They just focus on owning a collection of fantastic businesses, and then they wait, patiently, rationally, for the right opportunity to come along. It's this idea of disciplined opportunism, and it's baked into the DNA of both places. So where does that leave us? Well, it leaves us with a pretty big question to chew on. This whole story about Marmon, it kind of suggests that maybe the greatest competitive advantage a company can have, the one that really lasts, isn't a new technology or a famous brand or even a once-in-a-generation genius founder. Maybe, just maybe, it's a culture. A culture that's so strong, so deeply rooted in the company that it can keep guiding the ship for decades, long, long after the people who built it are gone.
You know, when you look at Berkshire Hathaway, on paper, it just doesn't make any sense, right? You've got a candy company, a massive railroad, a gigantic insurance operation, and a huge chunk of a soda company. It's one of the most successful companies on the planet, but it's also one of the most confusing. So, today, we're going to dig in and find the one simple core idea that explains how this random collection of businesses became such an absolute powerhouse.
Seriously? When you look at their portfolio for the first time, it's just chaotic. That's the only word for it. It's kind of like a corporate garage sale, except every single item is a billion-dollar company. So you can't help but ask yourself, how in the world do all these wildly different pieces fit together? Is there actually a method to the madness here? I mean, just look at this list. You've got a massive railway, BNSF, sitting right alongside See's Candies. You have this world-class insurance operation, and it's under the same roof as huge chunks of Coca-Cola and American Express. There's just no obvious industrial logic. You can't point to some synergy buzzwords. So what is the master plan? What's going on here?
Well, it turns out there absolutely is a master plan, and it's actually an elegantly simple philosophy that organizes this whole universe into two very distinct, very powerful empires. And if you can understand this one single division, well, that's the key. It unlocks everything about how Berkshire Hathaway really works. And here it is. It all comes down to this: the owner versus the investor. So on one side, you've got the wholly owned subsidiaries. These are the companies Berkshire buys outright. That's the owner empire, where they have complete and total control. Then on the other side, you have the investor empire. These are the minority stakes in public companies. Here, Berkshire has a ton of influence, for sure, but they can't dictate terms. The best way to think about it is like this. You've got permanent family members versus respected, but maybe temporary, allies. All right, so let's really dig into this family versus allies idea. Because, it's way more than just a clever analogy. This distinction dictates who they buy, how they interact with them, and frankly, it defines the very soul of Berkshire Hathaway.
Okay, first up, let's talk about the family. These are the subsidiaries. See, when Berkshire buys a company like See's Candies, it's not just a transaction, it's more like an adoption. They are bought with the intention of being kept forever. You'll see them proudly display a Berkshire Hathaway company on their logo. These businesses, they are the absolute bedrock. They are the Berkshire culture.
Now let's flip to the other side, the allies. These are the investees. So Berkshire will buy a ton of stock in a company like Coca-Cola, but they don't actually run it. This relationship is, well, it's a lot more fluid. These stocks can be sold, they can be traded. I mean, former holdings like Kraft or Disney have come and gone over the years, and some others just disappeared through mergers. They're incredibly valuable partners, don't get me wrong, but they are not family.
And this is where the story gets really, really interesting. Because this structure we see today, it hasn't always been this way. If you go back to the early 1980s, Berkshire was mostly an investor. Look at this, about 80% of its value was tied up in those minority stock positions, the allies. It was basically a massive stock portfolio that just happened to have a few businesses attached to it.
Okay, now fast forward to today. The picture has done a complete 180. It's totally reversed. Now, a whopping 80% of Berkshire is made up of those wholly owned subsidiaries, the family. And let me be clear, this was no accident. This was a deliberate, decades-long strategic shift from being a company that simply invests in businesses to becoming a company that owns them. But, numbers only tell you so much. To really get the why behind these two empires, you gotta look at the stories of the companies themselves. because it's these relationships that reveal everything about Berkshire's values, both as an owner and as an investor.
So let's start with a really legendary investee relationship, the Washington Post. Now, this was never just about a stock holding, not at all. This was a decades-long partnership, and it was built on a foundation of immense personal trust and mutual respect.
This timeline here really lays out the incredible history. So the Graham family takes the company public in '71, but they keep control. Then just 2 years later, Berkshire comes in and buys a pretty significant stake. And what does Warren Buffett do? He doesn't try to take over. No, he joins the board and becomes this deeply trusted advisor, first to Kay Graham and then later to her son, Don. It was this amazing two-way street. He taught them finance, and they taught him about journalism and leadership. It was a true alliance, one that lasted for 40 years.
And this relationship, it really became the blueprint, the model for what an ideal investee partnership should look like. It was never about control. It was all about mutual benefit. Buffett wasn't just some guy who owned shares. He was a counselor. He was in there helping the Grahams navigate really complex corporate strategy, everything from managing pensions to buying back stock. This was the ally concept in its absolute purest form. Okay, so if the Washington Post was really a bet on specific people, this next iconic investment, Coca-Cola, well, that was a different animal entirely. The bet here wasn't on a personal relationship. It was a bet on the indestructible, unstoppable power of a brand and its corporate culture. And man, what a bet it turned out to be. The investment has returned something like 12 times what Berkshire originally paid. And this wasn't just getting lucky. This was a deep, fundamental understanding of what makes a business truly, truly durable.
And this right here is the core insight. Berkshire jumped into Coke back in the late 80s because they saw a culture and a brand that was so powerful it could basically withstand anything. I mean, think about it. It survived the whole New Coke disaster, which was just infamous. It churned through 4 different CEOs in 13 years after the legendary Roberto Goizueta passed away. But the point is, the culture itself was stronger than any single person, and that is what Berkshire was betting on.
Now, this reputation for long-term thinking, for being patient, it gives Berkshire a unique kind of superpower. And that's the ability to act as a stabilizing force when there's a crisis. When markets are in a total panic and capital just vanishes, everybody in the know, they know there's one phone number they can call to get patient, hands-off capital.
The 2008 financial crisis is, of course, the perfect example of this. Let's take the Goldman Sachs deal. At the absolute height of the panic, Berkshire steps in. They invest $5 billion, but not in regular old common stock. They bought special preferred stock that paid a very hefty 10% annual dividend. So what happened? Goldman got the cash and maybe more importantly, the huge vote of confidence it desperately needed. And Berkshire? Well, they got paid very, very handsomely for being the calm in the storm.
And just look at the result. When you add up the dividends, a premium they got when Goldman bought the stock back, and a super favorable option they had to buy common stock, Berkshire walked away with a total gain of $3.2 billion. That's the kind of return you can earn when you build a rock-solid reputation as the one reliable partner to call in a crisis.
But it's not always about these quick, dramatic crisis deals. The story of USG Corporation really shows just how incredibly patient Berkshire can be. Okay, so they first invest way back in 2000. Then the company goes through a 5-year bankruptcy, and Berkshire, they held on. Then, fast forward to the 2008 crisis, USG gets hit hard all over again. And Berkshire didn't sell. They doubled down. They poured in another $300 million, and sure enough, 5 years later, that long-term bet paid off spectacularly. All right, so we've got the family of subsidiaries, and we've got the allies in the stock portfolio. But more recently, something new has popped up. A kind of hybrid model has emerged that might just point the way to the future of how Berkshire makes its deals.
You just have to look at the H.J. Heinz acquisition. This one was totally different. Berkshire didn't buy it alone. They partnered up with a private equity firm, 3G Capital. They each threw in billions. So now, Berkshire owns 50%. That means it's not a subsidiary, but it's a whole lot more than a typical investment, right? And here's the real twist. 3G, who are famous for their intense hands-on operational focus, they're the ones actually running the company. It's a pretty fascinating model if you think about it. Let the private equity experts come in and improve the business, while Berkshire just stands by as the patient, long-term owner, maybe ready to buy out the rest of it later on.
And all of this, it brings us right back to the central theme, the one idea that ties every single one of these deals together. This quote really says it all. It's the entire Berkshire philosophy in a nutshell. Chief executives come and go, whereas corporate cultures endure. So whether they're buying a family business to hold on to forever or investing in a global giant as an ally, the bet is always, always on the durability of the culture, not on the genius of any one single CEO.
Which, of course, leaves us with one last really fascinating question. Berkshire Hathaway has always preached this gospel that culture is more powerful than any individual. And yet, its own incredible culture was forged by two of the most legendary individuals in the history of business. So, as the company finally moves into a new era, the ultimate test is going to be whether its own powerful culture can actually endure and thrive beyond its iconic founders. It's really something to think about. Thanks for joining me. For decades, there's been one massive question hanging over the entire business world, and you've probably heard it a million times. What on earth happens to Berkshire Hathaway after Warren Buffett? We're not just talking about a company, we're talking about a legacy. Well, today, we're going to dig into the answer. We're going to pull back the curtain on the incredibly detailed plan that's been designed to make sure this icon of a company doesn't just survive, but actually thrives for the next 100 years. So let's dive in.
Now, you'd think this story would start in Omaha, right? In some big, important boardroom. But nope, our story actually begins in a much more interesting place. We have to go back to January 2012, to a company called Larson Jewell. They make custom picture frames. It's a tiny, almost forgotten corner of the massive Berkshire empire.
And then, seemingly out of the blue, the guy who'd been CEO for 20 years was out. A new, younger executive was in. Now, you might be thinking, so what? People change jobs. But this wasn't just a simple personnel change. This quiet little shuffle was actually a full-blown dress rehearsal, a secret test run for the much, much bigger challenge they were thinking about back at headquarters.
And that's our way in. This little surprise at a picture frame company is the key to understanding the whole puzzle of Berkshire's future. It shows you that long before anyone was talking about it publicly, the company was already hard at work, trying to figure out how to pass the torch and keep its unique culture alive.
So here's our game plan. We'll start right there with that surprise succession. Then we'll get into the huge, multi-billion-dollar question at the center of it all. We'll break down how they plan to split Buffett's job, meet the people taking over, uncover what I think is Berkshire's real secret weapon, and finally, look at how this whole thing is built to last.
Right. So that little test run at the picture frame company was basically just the warm-up act. Because for more than 20 years, pretty much everybody, from Wall Street to Main Street, has been asking one very blunt, very direct question about Berkshire Hathaway.
And there it is, the infamous hit by a truck question. I mean, the fear was always that the man and the company were basically the same thing, that without Warren Buffett, all the magic that made Berkshire would just vanish. And that single, stark question is what fueled years and years of intense planning to do something that seems almost impossible. Turn the unique genius of one man into an institution that can outlive him.
And just to give you a sense of the stakes we're talking about, look at this number. Back in 2013, when this plan was really taking shape, the company was already worth around $300 billion. Today, it's way, way bigger. I mean, the sheer scale of it all, the money, the businesses, the hundreds of thousands of jobs, it meant that getting this succession plan right wasn't just a good idea, it was absolutely mission critical.
So how do you solve the ultimate problem? How do you replace the irreplaceable? Well, the board came up with a pretty brilliant and honest answer. You don't. You just admit that nobody can fill those shoes. So, instead, you split the job in two.
The plan basically carves up Buffett's role into two distinct jobs. First, you've got a CEO. This person is a manager's manager. Their job is to oversee all the different businesses Berkshire owns. And then you've got one or more investment officers. Their world is the stock market, managing that enormous portfolio. And this really breaks it down perfectly. The CEO is focused on the actual operations, deciding where to put money inside the company and looking for new businesses to buy. The investment officers, they're pure investors. Their job is to manage the stocks. You see, it's two completely different skill sets, two totally separate jobs, all born from one legendary role.
Okay, so once you have the structure, the obvious next question is, who? Who are the people who are actually going to step into these giant roles? This brings us to the new guard.
On the investment side, you've got two guys, Todd Combs and Ted Weschler. Now, these aren't just good investors. They're world-class. They've already proven they can beat the market. But, and this is a huge but, they're facing a monumental challenge. Eventually, they're going to be managing a portfolio that is just astronomically larger than anything they've handled before. And at that size, just trying to outperform the market becomes a whole different, way harder ballgame.
Now, the CEO role. This is what I find fascinating. The job description isn't really about being a financial genius. It's about being a guardian of the culture. The right person has to be totally committed to this idea of permanence, that you buy a business to keep it forever. They have to respect the independence of their managers, and maybe most important of all, the plan is crystal clear. This person has to be an insider, someone who already gets it.
And boy, does Berkshire have a deep bench of insiders. For years, the frontrunners were seen as the heads of their biggest businesses. People like Ajit Jain in the insurance division, Greg Abel running the energy empire, and Matthew Rose from the BNSF Railway. The strategy wasn't just to pick one person early, but to grow a whole stable of leaders who were ready to step up whenever they were needed.
But here's the thing. The plan goes way deeper than just picking the right people. The most critical part of this whole thing, the real key that makes it all hang together, isn't a person at all. It's what I call Berkshire's secret weapon. It's totally unique ownership culture. Just take a look at this. Your typical big public company is mostly owned by giant institutions, mutual funds, pension funds that are constantly buying and selling. But Berkshire is completely different. A massive chunk of its stock is owned by regular individuals and families, people who don't think like traders, they think like long-term partners.
And this table from back in 2013 really shows you the skin in the game at the top. Of course, you've got Buffett with a huge chunk of the votes, but look at guys like Sandy Gottesman and Charlie Munger. These folks aren't just managers collecting a paycheck, they are massive owners. Their financial well-being is tied directly to the success of every other shareholder. This creates an incredibly powerful force field around the company. Shareholders just don't sell the stock. Turnover is almost nothing. People buy it and plan to hold it for their grandkids. It's why 40,000 people trek to Omaha for the annual meeting. They feel like true partners. And that loyalty, that's the cultural moat that will protect the company for decades to come.
Okay, this brings us to the final piece of the puzzle, the ultimate failsafe. The people who built this plan knew that future threats would come, so they built in one last line of defense specifically to protect the culture that made it all happen.
Because, let's be honest, in a post-Buffett world, you're gonna see a fight like this. It's almost guaranteed. You'll have this massive tug-of-war between the traditional Berkshire partners on one side and a new breed of activist investors on the other who are gonna push for short-term profits, big dividends, maybe even breaking up the company.
So how do you guard against that? Well, the plan creates one final, very special role on the board, a non-executive chairman. This person's job isn't to manage the company day to day. Nope. Their single, solitary mission is to be the ultimate guardian of the Berkshire culture. That's it.
And the person chosen for this critical role? Warren Buffett's own son, Howard. And when you think about it, it's the perfect choice. As a longtime director and, well, a Buffett, he has a perspective that no one else could possibly have on his father's values. He's the final backstop.
And this quote from Howard himself really says it all. You can hear it in his words. For him, this isn't just a corporate job. It's personal. It's about protecting his father's legacy. That personal commitment is the final layer of armor on this entire plan.
So in the end, what we have is a fortress, a company protected by a structure of smart people, a unique partnership culture, and a final guardian with the family name watching the gates. It is, without a doubt, one of the most thorough succession plans ever created. But it really all boils down to one last question, doesn't it? A fortress is only as strong as the people who are willing to defend it. And when the pressures of the modern market come knocking, will the next generation of leaders have the guts to hold the line? Only time's going to tell.
When you hear the name Berkshire Hathaway, you probably think of staggering success, right? An empire built on wisdom and patience. It's a modern business legend. But what if the real story, the secret to its incredible longevity, isn't just in all the wins? What if it's actually found in the messier stuff, the contradictions, the mistakes, and the constant underlying tensions? Today, we're going to deconstruct that legend. In this quote, Will, it just cuts right to the chase. It's a perfect dose of reality. Berkshire is not a fairy tale. It's a real business with real-world problems that sometimes require very tough, very normal business solutions. And maybe its greatest strength isn't pretending to be perfect, but in knowing, really knowing, its own limits and how to work with them. So here's our game plan. First, we're going to tear down that fairy tale image. Then we'll dive headfirst into what I call the paradox of autonomy. After that, we'll explore their bizarre yet brilliant method for buying companies. and the serious ethical tightrope they walk with decentralization. Of course, we have to tackle the big one. What happens after Buffett? And finally, we'll look at the core trade-offs that, believe it or not, really hold this whole thing together. All right, Section 1, let's start with that classic image of Berkshire as this totally hands-off owner. You know the story: buy a great business, hire a great manager, and then leave them alone. Well, that's the ideal for sure, but the reality, it can be a whole lot different. Sometimes you got to get your hands dirty. So let's take a look at a company called XTR Corporation. Back in 2001, Berkshire buys them. Now, on the surface, they were a leader in their field, leasing those big truck trailers to giants like FedEx, Walmart, you name it. But here's the catch. Under the hood, the business was a mess. It was bleeding cash, weighed down by massive overhead and just terrible profits. This wasn't a gem. It was a fixer-upper. And that's exactly what makes it such a fascinating and frankly un-Berkshire-like story. Now, look at this timeline. If you didn't know better, you'd think you were looking at a private equity firm's playbook. They didn't just sit back and watch. Oh no. Within just 3 years, they completely changed the game. They brought in a new CEO, they physically moved the entire headquarters from expensive Connecticut to St. Louis to slash costs, and they sold off a major division to refocus the company. These are aggressive, surgical moves, a world away from that patient, hands-off reputation.
And look, Extra isn't some isolated case. A key part of Berkshire's cultural strength, its immune system really, is Warren Buffett's incredible honesty about his own screw-ups. He'll tell anyone who listens that the Dexter Shoes deal was an absolute disaster. He's open about the years of pain Gen.R.E. caused. And he even calls his first investment in the company, that original textile mill, a doozy of a mistake. You see, this brutal honesty is what prevents the empire from getting sentimental and being paralyzed by its own past.
So this need to step in sometimes leads us right to the central conflict at Berkshire, what I call the paradox of autonomy. The entire company is built on this sacred idea of leaving managers alone to do their thing. But it begs the question, where is the line between trusting your people and just walking away from your responsibility as an owner?
The official definition here tells you everything you need to know. It starts out so strong. Managers have command over all operating decisions. That's the promise, that's the deal. But then you get this little kicker at the end. This is not intended to be an abdication of oversight. That phrase right there is the whole ballgame. It's the tightrope they have to walk every single day.
And believe me, this isn't just some theoretical problem. This paradox has real teeth. Take NetJets, where the management's financial decisions got so out of line that Buffett himself had to step in and force a leadership change. Or think about the David Sokol crisis, a huge insider trading scandal that grew directly from the soil of too much unchecked trust in a single manager. It shows that autonomy, when it goes wrong, can cause some serious damage. So, if managing these companies is so complex, you have to wonder, how do they even end up in the Berkshire family to begin with? Well, this brings us to part 3, the uncorporate acquisition playbook. And folks, this is where the story gets really, really interesting and kind of weird. I mean, just look at this comparison. It is night and day. A typical big corporation is all about process. They have strategic plans, armies of investment bankers, they're actively hunting for companies, and they spend months digging through every single document in due diligence. Now, take all of that and just throw it right out the window. That's Berkshire. Their own word for their process is haphazard. They wait for the phone to ring, and that exhaustive due diligence? Nope. Often, it barely happens at all. And this isn't just a fun story. The numbers are staggering. If you look at 35 of their major deals, a mind-blowing 77% of them came to Berkshire. The sellers called them, their business partners made an introduction, a friend of a friend reached out. They only went out and initiated the contact themselves about 11% of the time. They don't have to hunt, because over decades they've built a reputation as the one place everyone wants to sell their life's work to. And the process itself? It's a masterclass in radical simplicity. A phone call leads to one meeting. Often it's less than 2 hours long. Buffett is sizing up the business, sure, but he's really sizing up the manager. Then comes the legendary part. He names one price. Just one. That's the offer. Take it or leave it. No haggling. And from there, a deal worth billions of dollars can be signed, sealed, and delivered in less than a month. It's a system built entirely on trust and gut instinct, not on spreadsheets. Okay, so this collection of independently run companies, all brought in through this unique process, creates our next big challenge, the decentralization dilemma. Because on one hand, the structure empowers managers to do incredible things, but on the other,
it creates some truly dangerous blind spots that raise huge questions about corporate responsibility.
So let's start with the bright side. Because when this model works, it really works. You get managers who are true stewards of their businesses. Shaw Industries basically pioneered recycling in the entire carpet industry. McLean launched a huge initiative to make their truck fleet greener. And the key thing here is, these weren't orders coming down from Warren Buffett in Omaha. This was the result of giving good leaders the freedom and power to do the right thing from the ground up.
But, and you knew there was a but coming. That seam freedom, that very lack of top-down control, has a very, very serious downside. The entire system is built on the assumption that managers will be quick to report bad news. So what happens when they don't?
Well, the Russell Corporation case is the perfect and honestly a pretty chilling example of what happens. One of their subsidiaries was caught up in some awful stuff, sweatshops, anti-union activities. But here is the critical flaw in the system that this exposed. Berkshire's top leadership had no idea until an activist stood up and made it public at the annual shareholders meeting. Now, to their credit, they fixed it fast, but it revealed the model's deepest vulnerability. When things go really wrong, headquarters can be the last to know.
So all of these paradoxes, all these dilemmas, they all funnel down into the single biggest question facing this company. It's the elephant in every room. Is this strange, powerful, and yes, sometimes flawed culture so deeply tied to one man that it can't survive him? Can Berkshire actually last without Warren Buffett? To answer that, it's useful to compare Berkshire to another legendary company, Teledyne. Its founder, Henry Singleton, was an absolute genius, but he was a micromanager. He was the center of that universe, and when he retired, the whole thing fell apart. Now here's the great irony of Berkshire. The very decentralization that causes some of its biggest risks is also what might just be its salvation. Buffett has intentionally built a company that doesn't need him for the day-to-day. The culture isn't in Omaha. It's fused into the dozens of businesses themselves. Or think about the difference between Berkshire and GE under Jack Welch. Welch's philosophy was famously like a game of gin rummy. If your business isn't number one or number two in its market, you get sold. It created this intense survival of the fittest culture. Berkshire is the polar opposite. Their philosophy is to buy and hold, basically forever. They're reluctant to sell even a struggling business. That builds a culture of permanence and stability, not constant churn and fear. And that brings us to our final section, and maybe the most important one, the final trade-off. Because the truth is, for all its powerful principles, Berkshire is not a simple machine. It's a place where core values are often in direct conflict with one another, forcing leaders to make incredibly difficult choices. And these are not abstract academic questions. I mean, really think about these. How do you balance the need to save money against the very real human impact of closing a factory that's been the lifeblood of a town for a century? At what point does a manager's entrepreneurial drive become too risky for the parent company's conservative balance sheet? And what in the world do you do when one of your companies wants to launch a hostile takeover, something that goes against everything Berkshire says it stands for? Who makes the final call? When push comes to shove, who decides? Well, this quote from James Hambrick, a CEO of a Berkshire company, says it all. It lays the ultimate truth bare. For all the talk of freedom and autonomy, every single manager serves at the pleasure of Berkshire. Autonomy is not a right. It is a privilege. It is earned every single day. And that, right there, is the ultimate check and balance in this entire incredible system. So after we've looked at the myths, the paradoxes, the mistakes, and the tough calls, we're left with this one big question. Is the Berkshire Hathaway model a timeless blueprint for success, a set of rules that any company could follow to achieve greatness? Or is it a one-of-a-kind masterpiece, a work of art so unique to its creators and its history that no one could ever hope to replicate it? You know, when you think of Warren Buffett's Berkshire Hathaway, you probably think of stock picking, right? But the real secret, the magic, isn't about what it buys. It's about how it's built. I mean, we're talking about a massive empire that somehow just thrives with almost nobody running the show from the top. So today, we're going to pull back the curtain and really deconstruct that invisible but incredibly powerful culture to figure out what truly makes it tick. Okay, so here's the game plan for our deep dive today. First up, we're going to tackle the big mystery, the Berkshire enigma itself. Then, we'll get into their totally unconventional rulebook. After that, we'll look at the human side of things, the purpose and, the philanthropy that really fuels the whole operation. And we'll wrap up by asking the million-dollar question, can this whole thing actually last once Buffett is no longer in the picture? All right, let's jump right into this core puzzle. I mean, how in the world does a company with hundreds of totally different businesses, we're talking everything from insurance to candy to railroads, run with a headquarters that's, well, tiny? It's almost non-existent. It's a setup that pretty much flies in the face of everything they teach you in business school. You know, to really wrap our heads around this, I think the best way is to look at a single story that just says it all. And that's the story of Business Wire. So this company starts out as a tiny one-man operation way back in 1961, and over the decades, it just grows and grows into this global powerhouse. But here's where it gets really interesting. When the CEO, Kathy Tamraz, realized they needed a permanent home for the company, she didn't call up the investment bankers on Wall Street. Nope. She sat down and wrote a letter straight to Warren Buffett. And this right here, this quote, is the part of the letter that made Buffett sit up and take notice. It's just one paragraph, but listen to what she's saying. We run a tight ship, no management layers, but we'll invest big for technology. It was like she was describing Berkshire's own DNA. I mean, it was just a perfect cultural fit, a real light bulb moment. So this really gets to the heart of that enigma we were talking about. I mean, look at this. On one side, you've got your typical corporate headquarters, right? It's this whole tangled web of management layers, budget reviews, endless meetings, the whole shebang. And then you've got Berkshire. It's just the opposite. The entire philosophy is to manage as little as humanly possible to avoid all that business school nonsense. It's a completely different way of thinking about how to run a company. So you've got to be wondering, right? If they throw out all that normal corporate stuff, how does anything get done? How do they make it work? Well, the answer isn't some 1,000-page manual. It's actually much simpler and way more powerful. It's a set of shared values that have become their actual operating system, making all that bureaucracy totally unnecessary. Okay, so you can pretty much boil down the entire Berkshire way of doing things to these 5 core ideas. It's their blueprint for success. Be frugal, reinvest your profits like a genius, find those entrepreneurial superstars and let them run, give them almost complete freedom, and underpinning everything is just this unshakable sense of integrity. And make no mistake, these aren't just nice-to-haves on a poster. These are the absolute pillars holding up the whole thing. So let's dig into each one. All right, first up, be frugal. And it's really important to get this right. This isn't about being cheap for the sake of being cheap. It's about being smart and efficient. It's a whole mindset. You can see it in GEICO's low-cost business model. That's their entire competitive advantage. You see it in stories like B.E.R.K.H.I.R.E turning around R.C. Willey after his father-in-law was, well, a bit of a spendthrift. And you definitely see it in this deep distrust of expensive debt, a lesson a lot of these old school leaders learned firsthand during the Great Depression. Okay, principle number 2. And this is the absolute engine of Berkshire's incredible growth. Reinvesting profits wisely. It's all about allocating capital in the smartest way possible so the money flows to the businesses that are going to generate killer returns. Think MyTech or Berkshire Hathaway Energy. But here's the flip side, and it's just as crucial. They deliberately don't put money into businesses that won't give them those high returns, even if they're well-loved brands like the Buffalo News or See's Candies. It's a very disciplined and, frankly, unsentimental approach. And yeah, there's just no room for emotion in this process. The commitment is to rational decisions, not to sentimental attachments. I mean, think about it. Buffett himself made the incredibly tough call to shut down the original textile mills, the very business that gave Berkshire Hathaway its name. And he did it again with Dexter's shoe plants years later. The message is clear. Capital has to perform, or it's going to get moved somewhere else. Simple as that. So that brings us to the third rule, which is all about trusting in people. Instead of this top-down, command-and-control style you see everywhere else, the whole idea is to find these amazing entrepreneurs and then just get out of their way. Let their energy, their ideas, fuel the growth. This is so critical to understanding how the whole system actually works on a day-to-day basis. And that flows perfectly into principle number 4, which is probably the most famous part of the Berkshire playbook, radical autonomy. I mean, it's almost unbelievable. Berkshire buys a fantastic business and then just leaves them alone. That level of trust is a superpower. It empowers everybody down the line, whether you're a paint distributor for Benjamin Moore, a Dairy Queen franchisee, or one of the thousands of consultants for the Pampered Chef. You are the boss. You're trusted to run your own show, period. And if you want to get a sense of just how massive this trust-based system is, just look at that number. Nearly 600. 600 separate business units, all running themselves, all operating under this philosophy of decentralized management. Just let that sink in for a second. There is literally no other company on Earth structured like this. It's completely unique. But, it's not all just a cold, hard, number-crunching machine. This intense drive for performance has a really profound human side to it. There are real costs, real trade-offs for the people inside this culture, but there's also this incredible sense of purpose that goes way beyond just making a profit. And the pressure on the leaders within Berkshire is, well, it's immense. This slide captures that tension perfectly. On the one hand, you have absolute legends like Rose Blumpkin from Nebraska Furniture Mart, who famously said, "I work to avoid the grave." The business was her entire existence. But then you have another leader, Randy Watson from Justin Brands, saying the complete opposite. Go to your kids' events because they only go through first grade once. It just goes to show you that even inside this culture, there's this constant push and pull, this real conversation about what success and a good life really mean. And it's not just about the work ethic. There's another huge part of the culture here, and that's this deep, widespread commitment to giving back. And we are talking about staggering amounts of money. I mean, look at this. The Dairy Queen franchisees alone have raised over $100 million for the Children's Miracle Network. The employees at McLean, over $65 million. This isn't some little corporate fundraiser. This is philanthropy on a massive grassroots scale. And the really crucial thing to get here is that this is not some top-down corporate mandate for good PR. It is deeply, deeply personal. You've got Al Yelchin from Flight Safety, who founded a flying eye hospital, for crying out loud. You've got Lori Loki, the guy from our Business Wire story, donating over $400 million. I mean, from guys dressing up as Santa for kids in the hospital to creating crisis funds for injured rodeo performers, the giving is just as unique and individual as the leaders themselves. So, when you put it all together, the frugality, this radical autonomy, the personal drive to give back, it all leads to the biggest question of all. Can this amazing culture, which seems so connected to Warren Buffett himself, actually survive without him? Is the company, the culture, his true legacy? Well, if you ask Warren Buffett, he doesn't hesitate. He's been crystal clear on this. He believes that the Berkshire culture is now so deeply ingrained, so baked into the DNA of every single one of its companies that, and this is a direct quote, "These operations won't miss a beat when I die." For him, the legacy isn't the stock price or the billions of dollars, it's the enduring institution he built. And his whole strategy for making sure the company survives and thrives can be summed up with one of his favorite analogies, and it comes right from the poker table. In any poker game, there's a patsy. The patsy is the sucker, the easy mark, the one who's guaranteed to lose their money. And Buffett's first rule of business, just like in poker, is simple. Figure out who the patsy is and make sure it isn't you. So how does Berkshire make sure they're never the patsy in the high-stakes game of business? Well, the strategy is brilliantly simple. First, they stick to what they know. They only play in games they can understand, simple, basic businesses. And second, and this is the absolute key, they build the entire thing on a bedrock of trust. They only do business with people they know are honest, trustworthy, and share their values. By being incredibly careful about who they partner with, they basically remove the risk of getting played. And this combination of trust and simplicity, this is what creates Berkshire's ultimate secret weapon, its true competitive advantage, permanence. Think about it. A private equity firm, they buy a company and they're already thinking about how they're going to sell it in 5 or 10 years. Berkshire offers a permanent home. And that one difference changes everything. It frees their managers from the short-term craziness of quarterly reports and lets them think and plan for the next 50 years, not the next quarter. And that really is the central belief here. The legacy isn't just one man. It's an entire institution that's built on a foundation of timeless values. And again, these aren't just fluffy words on a corporate retreat poster. They are a powerful, profitable, and proven business model. Thrift, integrity, autonomy, permanence. These values are the source of Berkshire's enduring financial strength. So that leaves us with one last big idea to chew on. In a world that is completely obsessed with this quarter's earnings, with short-term gains, with instant gratification, maybe the ultimate lesson from Berkshire Hathaway isn't about stock picking at all. Maybe it's that the greatest, most powerful, most durable competitive advantage you can possibly have is to simply build something that's meant to last.